The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning on TV and radio for our audience worldwide. This is Bloomberg Surveillance, and here's your price action in the equity market. Up 1/3% on the S&P 500. On the NASDAQ, up about 0.2%. The last time the Fed met on March 16th, since then we're down somewhere between 4 and 6% on the S&P 500 and the NASDAQ. So equities have gapped lower since this Fed met. But you will remember, Bramo, on the day, equities were not lower. They were higher after that meeting, and I think we're all scratching our head as to why.
Well, it just goes to show that the first reaction in markets to the Fed's response perhaps is not the correct one, that you actually have to read the documents and actually understand that. And I think that that's the takeaway, because really, Fed Chair Jay Powell telegraphed what he planned to do, and he's doing it, and people seem to be surprised.
And this move in the bond market started to bite in a big way. Look at where we are now compared to where we were. On March 16th, 194 on 2s, right now 278. Back then on March 16th on 10s, 218, right now 295. Yields in a couple of basis points today on a 10-year by 2 and down 2 as well on a 30-year. But the move we've seen over the last few months, Tom, has been absolutely massive on 2s and 10s for that matter. And the surprise for me, TK, was on the 10-year.
And also with the banking move as well. I mean, you see it with Mike Mayo with us the other day, Ken Leon's wonderful work during the earnings. We mentioned Apple flat from March 16th. JP Morgan 138. Now down to 123 off the Fed meetings.
It's been a tough year so far for the big banks on Wall Street. On the stock price, we can now catch up with Jamie Dimon of JP Morgan, sitting down with Bloomberg's Francine Lacroix.
Thank you so much, John. Yes, we're in London, and we could not be more pleased. I say the royal we. We're really delighted to speak to Jamie Dimon. Thank you so much for taking the time whilst you're in London to speak to us. So the Fed. Today, we're expecting 50 basis points hikes. What happens to inflation here? Is this your biggest concern?
So Francine, happy to be here. And to give it a little perspective, we have, and this is contradictory I'm about to say, but both are true, very strong U.S. economy.
Yeah.
Consumers in great shape, lots of money, spending the money. Jobs are plentiful, wages are going up, though everything's distorted by inflation and all that, but those are good news, and businesses are in very good shape, and the Fed is going to have to raise rates and reverse QE. And they're going to, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. And I wish them the best.
Yeah.
We're a little late, but, remember 2 years ago we had 15% unemployment and no vaccine. So I think people should take a deep breath, give them a chance, and I think they're going to move. I think the sooner they move, the better. So, yeah, they're going to be raising rates.
Deep breath, but can they engineer a soft landing? Or is there a worry of recession in the US?
Of course, but none of us will ever know, right? But if I had to, I'm not a betting man. The odds are the following. Something like, yes, they can engineer a soft landing, 1/3% chance. Probably 1/3% chance they can engineer a mild recession. Think of, we've had mild Fed-induced recessions before, where inflation goes up 1.5% or 2%, everything slows down, inflation's coming down, and it's 6 or 9 months. And then there's a chance it's going to be much harder than that. And then in the face of all of that, you have Ukraine, which is a huge global issue. And
do you fear the Fed? And do you fear a policy mistake from the Fed and what that does to consumers?
I'm not afraid of the Fed. I'll change the subject a little bit. I think America needs very good domestic policy to improve the growth of the economy, which makes the Fed job easier. And that is about regulations and rules and policies and improving projects and things like that. So you have, increase the supply side as opposed to, do something on the demand side. So the Fed's job would be easier if we had very rational, thoughtful economic policy.
What could go wrong, though? I mean, you talk about, a strong U.S. consumer, strong business. You talked also about storm clouds. What are those storm clouds, and what's worst-case scenario? Right?
Yeah, I hate the word unprecedented, but there's kind of fiscal and monetary-induced unbelievable growth in the U.S., which was true around the world, though it's obviously slowing down in Europe. That's abnormal. We've never really quite had that before. We've never had QT before. So, you look at QE, that's one of the greatest experiments ever done. They're going to be writing books for 50 years on it, and we're going to have to reverse it. And that's a huge change in the flow of funds over time around bonds and rates and stuff like that. My own view is that rates will still have to go up from here. And then you've got Ukraine, which, I think is a potential, when you look at Ukraine, obviously the wishful thinking is we have a Fed-induced slowdown works. The world is fine, Ukraine resolves, but there's a chance that this goes on for years and that you completely rattle global energy markets, wheat markets, commodity markets, and and we need, as the Western world needs to be prepared for that and needs to take every action today to be prepared that can get really bad tomorrow. And when it gets really bad tomorrow, you don't have time.
So how do you handle that? What's your plan B if it does go all pear-shaped?
I like the fact that it will deal with it. That's life.
But how?
I like in my view, the most important thing is American growth, and that America, I call it this Marshall Plan for energy, that we do everything we can, and this doesn't violate climate change, it doesn't change anything about long-term objectives, but that we do everything we can to get oil and gas into the hands of Europeans so they don't freeze in the winter. And again, I'm not saying it's going to happen, but you have a couple of problems out there. The national energy stuff the global energy is precarious. And if oil goes to 185, that's a huge problem for people, and we should do everything we can today. We need to pump more oil and gas. We need to improve pipelines. Why are they
not, Jamie? If you look at the U.S. frackers, they could drill more.
We get confused about policy and that somehow doing that is bad for the climate. It's not. We need, if you want transition, you need gas to replace coal. And we should approve all the green stuff, too. Even the green stuff takes 5 years to 10 years to approve in the United States. I mean, America needs to get its act together, and they should have a war room. They should get everyone involved, get all the people, and say, what do we need to do in a consistent, coherent way? We need to get more gas to LNG terminals. Well, you can't do that without a gas pipeline, And so we're just not rational anymore. We have misconceived notions about how we're going to get things done, and they're trying.
What's the role of Europe in this? Could Europe see a recession because of the energy prices?
Absolutely. Our economists would say that Europe has slowed down to 2% or something. But the problem with right now, and the economists would agree with me, we're looking at a static analysis, that if things stay the way they are. But you and I know for certain things don't stay the way they are. And my view is there's a very high chance that oil will go higher. It only takes 1 million to 2 million barrels off the market a day that can drive prices up $30 or $40. And so we should prepare for that today. And but I like the fact, I think it's great that the Western world has gotten together.
Yeah.
I mean, who would have thought that
Europe,
Putin would get Sweden, Finland, Germany, Switzerland, all of us but that working together part, we need to make permanent for global security.
James, first of all, just going back to the European economy, how quickly could we see a recession, and how deep could it be?
I don't know. I mean, I hate to guess the future. No one really knows the future. I've never seen anyone really guess it well. But again, if Ukraine gets worse, I would assume that Europe's going to go into a recession. It may take a couple of quarters, but I would assume that.
Are sanctions working? So are the sanctions trying to deter Russia from continuing the war in Ukraine, or is it just to try and put the Russian economy on their knees?
Yeah, well, sanctions is not the same as having tanks and airplanes, okay? But they are working to the extent that, the Russian GDP is going to drop by 10 or 15% with the current sanctions. And remember, there are sanctions, and also the export controls and stuff like that. And, the next round, if Europe really stops oil, and you can really stop oil being delivered, Russia, it can get another 10% down. So it's a tool in the toolkit. It's not definitive. What's definitive is tanks. So, we're not, don't confuse the two, but, one is a pretty powerful, the sanctions are a pretty powerful tool.
But if you expect this to last for, I think you said years.
I don't expect it. I said we should be prepared for it too. I don't know what's going to happen.
But how do you see this ending? And actually, if you're a president of the U.S., if you're a president of the Commission, if you're the Fed right now, you need to game theory, and it could go either way. It's like a three-way system. Mm-hmm. So what do you do?
I would plan for all three of them. I think it's a mistake to guess at which one it'll be. It should be all three of them. And I think basically the Cold War is back. I think the whole world learned something that we always knew, that national security is always the most important thing, but it kind of recedes in the background. We're all doing well. But now it's the most important thing. It should be the most important thing for the rest of our lives. So maybe we all learned that is a permanent state of affairs. The Cold War is back. The allies have to coalesce, and not just for military purposes, but for global economic, strategic investment purposes, so that we've got a safe world. If we don't do that, you see Ukraine, you can see all around the world. You will see forms of chaos.
So the impact on the economy, I mean, would you go around a trading floor and tell the young kids that have never dealt with inflation that actually interest rates could be up at 5% shortly?
Of course. I mean, of course, that's, things change. And, I think you can easily see 5% bonds. Now, bonds have already, 10-year bonds have already reacted dramatically, and hopefully it won't go a lot. But I don't think it's a disaster. I don't think a slowdown is a disaster. I don't think look, when you say a mini recession, I feel for the people who get hurt in that. But it's not a disaster for the world economy. I think the potential outcomes of Ukraine are. And you got to just separate the two. And just remember, when you talk about war, we didn't know how bad Vietnam was going to get. We didn't know how long Afghanistan was going to last. The Russians didn't know how long Afghanistan was going to last. You can go war after war after war. They were not predictable. You didn't know that World War I was going to be like that. You didn't know that World War II was going to start in September of 1939. So I think predicting the outcome of this war, you got to be very careful.
But so why are markets so relaxed?
That's markets, that can change just like that.
Do you think it will, or are we expecting a big correction?
I'm not guessing. I don't know. I mean, again, Francine, my job in life is I will serve our clients through thick or thin and our country, stuff like that. And of course, we're always, as a rule of thumb, we're always prepared for bad outcomes, not because we're predicting them, because I need to say to the shareholder, the American public, my regulators, the UK, that JP Morgan will be safe and sound and help your country and your people if things get bad. And that is our job. Now we're dealing with a whole bunch of different things, and we're prepared. We have extraordinary capability and capital and earnings power. And
where's China in this right now?
Look, my view is that China can't possibly like this. And they're playing, if you look at them, they're playing a very neutral role. They're not trying to anger the United States. They know that the American Congress may very well, the Congress, not just the president, can come in and put these secondary sanctions. They do $3.5 trillion of trade with the West. Imports and exports. They do $150 billion with Russia. Okay, one number is critically important. Sanctions against them may be bad for the Western world. It'll be even worse for them. And so they don't need that. They want to grow their country. They want to expand. Maybe they don't like the West so much. They like this. I just don't believe that's true. I think that they're caught between a rock and a hard place. They have this so-called ally who's putting them in a difficult place.
Can we still rely on China, given the COVID zero policy, and actually the shocks that's coming just from that policy continuing?
I think China has done, you got to put China in perspective. It's done a very good job developing itself over 30 or 40 years. It doesn't have all the strengths of the Western world. Okay, it doesn't have our food, our water, our energy, our innovation, our rule of law, the competition of ideas. Autocracy has huge negatives. They don't have enough food, water, and energy. Their neighbors are very complex. Russia, India, Pakistan, Afghanistan, Philippines, Japan, Korea. It's hard for them to be expansionary. They don't have a lot of things we have. So, yes, I think we should be worried about them, and I think the West should negotiate, how we're going to deal with trade, unfair competition, IP, but sit down with them.
Yeah.
Work it through with them. We don't need to be afraid of them. We should be afraid of is our own incompetence, not dealing with the Chinese. As long as we stay together. If the Western world doesn't stay together, they'll cherry pick every nation, and then you'll end up with what you had with Germany and Nord Stream 2. That will be a problem.
Jim, are you committed to China? So if we're seeing a split, and we're seeing the HSBC and investor activism, could you see big banks actually being split in two because of this East-West tension?
No. I think, again, you got to look. I mean, business you run for 30 or 40 years. So we've made a big investment in China, greater China, including Hong Kong, et cetera, will be 30 or 40% of the global market one day. They will be a fully developed nation in 20 or 30 years. Their politics will change. Is there a chance of a very bad outcome that, the world completely separates? There's a chance. That will be bad for J.P. Morgan, but we'll survive. But I think there's a much bigger chance that the blocs will negotiate strategic, economic, a bunch of other arrangements. Like I said, it's 3.5 billion trade.
But this over what timeline?
What will change?
Like 5,
what
10
will
years?
change?
Yeah.
It'll take time. What will change is anything to do with national security, anything. So think of AI, 5G, penicillin, rare earths, semiconductors. Those supply chains will be brought back, as Janet Yellen said today, will be friendly sourced. It doesn't have to be in the States. It's got to be in an ally. And so I think all nations are going to do that. China already does that.
Yeah.
So this is a unilateral thing. And I think the rest of the trade will be fine, or fundamentally fine. And that may take time. But but that will happen over time, and it's kind of a little surprising to me how much the Western world relied on China, not for trade and for sneakers and for shirts and stuff, but for rare earths.
But they have them. We don't.
No, we do. That's the whole thing. America's got tons of rare earths. It just will cost a lot more money to take it out and smelt it, and they're environmentalists and all that. That's why I'm saying national security. Yeah. If I was in the White House, the only thing I'd be doing now is national security. And I'd be making decisions every day about how we create more secure energy, rare earths, commodities, wheat, all the things that the world's going to need, not against China, but to protect the Western world. And so all these things could be done. America's not used to having industrial policy. But to do that successfully, you're going to have some form of industrial policy where you're doing some kind of subsidies. It should, but be clear, I don't want to subsidize a company.
Right.
I just think some of these things need to be brought back to the United States.
This will probably be inflationary, right? Is crypto a hedge against inflation?
No.
Right now?
No. I think the higher rates go, the more cost to hold. An asset doesn't produce anything. So, but I think national security is number one. I would not do something because of inflation, because of national security. They are completely different. And people shouldn't get confused the two. And this is why America has to take leadership on that. This is a matter of national security. If everything turns out fine in Ukraine, we'll all take a deep breath and say, we overreacted. I'd rather that than we all take a deep breath and say, my God, we were not prepared. And
when it comes to Roe v. Wade, we've been talking about nothing else for the last 2 days. What does it mean for J.P. Morgan and your employees?
I'm not going to get involved in that. I think it's a mistake. These things are very complicated. And when people pass laws everywhere, there's actually 100 things in the law.
This is costs, right?
No, it's not. Insurance? There are 100 things in all these laws. 100. And so when people say support this, support that, all you're doing is being sucked into support something you probably shouldn't. Yeah. I've looked at all the voting laws. I looked at all these laws, and you look at them. I agree with some of the things they say. I don't agree with some of the things they say. New York does a better job than Georgia. So I'm not going to get sucked into saying I support your law.
But instead of support, do you see actually for such a big bank in the U.S. having to shift because of policies?
Whatever it is, we'll deal with it. I don't sit here in fear of that. Whatever it is, we'll deal with it. And we'll take care of our people like we've always said we would.
All right, Jamie Dimon, thank you so much. I need to talk to you about the UK. We need to have a conversation also about the UK and the City of London. Jamie Dimon, and we'll have plenty more from London throughout the day.
Francine Lacqua, thank you. Sitting down with Jamie Dimon, the CEO of J.P. Morgan Chase. A range of comments there, Tom, on the current state of the economy and on crude as well. We need to do everything we can to get oil and gas to Europe. Seems to be a pressing issue for the Europeans, Tom, at a time where the EU's come out with a plan to wind down its use of Russian crude.
And I was thinking as he was commenting on Europe and oil, the definitive 100 pages they just wrote on the demand mystery of oil. And I really can't say enough, John, with the China lockdown. What happens when China unlocked down, and what does that do to diesel? What does that do to a gallon of gasoline as well?
And the demand that returns, TK. Let's reset and just go through some of the price action for you. Look at equities as you wake up and look ahead to potentially, most people think we will get one, a 50 basis point rate hike from the Federal Reserve. Equities up about 0.4% going into this, but there has been some damage to this market over the last couple of months in both equity and credit. And yields, this has been the problem, Lisa. On the equity side, it's been tough. Credit, it's been tough, but the bond side too. Yields have been higher, much higher on 2s and 10s since this Fed last met on March 16th.
Yeah, how many notes have you read about the month of April and how nothing worked? And that basically was the theme there. I was looking at a financial condition index put out by Bloomberg and how things have tightened substantially. I keep going back to Ben Laidler. Have they tightened enough to actually slow some of the demand and slow inflation, considering the fact that we're at 2018 levels? We're not back to some sort of serious contraction in those conditions.
Euro dollar, the last time the Fed met, Tom, that day we closed at 110.35.
Yeah.
Right now, 105.25.
Yeah, we're going to be doing that through the day, folks, compare and contrast to March 16th. I can't imagine, John, what it's going to look like March 16th out to that meeting that follows here on May 4th. I also can't imagine short-term paper. Deborah Cunningham briefs us now. Global Liquidity Markets Chief Investment Officer, Federated Hermes. We're thrilled that she could join this morning. Deborah, what does this Fed meeting mean for the trust market, the very short-term paper market?
Well, from everything that's basically 3 months and under, it should adjust up by close to, if not exactly, 50 basis points. So short-term returns on money market funds, short-term returns on other types of liquidity pools should be on the increase. Yes, equity markets have had a hard run of it in the month of March and now April. Certainly longer-term bonds have, but shorter-term fixed income in the liquidity markets is returning positive returns, and those are going up at this point.
Are there instabilities out there? I mean, this word liquidity and solvency, they get conflated. People flunk the CFA over the nuances of solvency and liquidity. Give us an update. Now, I assume solvency is fine. You want to tell me it's not? I'm listening. But tell me about the liquidity dynamics, the oil in the engine that you and Federated literally invented. Tell us about that.
Well, it's okay at this point. And certainly when we went into the pandemic, the health of credit organizations from a solvency standpoint was very, very high. And if anything, we did not deteriorate that in most industries too much because of, thankfully, stimulus from the U.S. government. And that has been helpful to lead us now into a period where the stimulus from the Fed themselves, monetary stimulus, is going to be withdrawn. Now, it's still a stimulative situation with interest rates at 75 basis points on an overnight basis. You're still at something that's quite accommodative from a monetary policy standpoint. It really doesn't become prohibitive from a growth perspective or from a monetary health standpoint for institutions until you get to something that's above inflation. So, who knows where the long-term run of that is right now, but it's certainly not at 2%, 3%, somewhere in that neighborhood. And even with the 10-year at 3%, that's still a bit accommodative. From a liquidity standpoint, there's lots of good way to and from flow. So lots of bid asks being hit, the spread being low at this point between those bids and asks in most markets. And there's still a substantial amount of new issue paper coming to market with a lot of demand.
When I start seeing short-term yields go up, I wonder when I can get excited to go to the bank and get a toaster gifted to me and get some sort of real return on a CD. How far away are we from that point?
Well, banks on an increasing rate environment tend to have a low response rate. Generally speaking, they lower rates on CDs quicker. When interest rates are going down, then they increase them. There's something called, a beta that's in the neighborhood of about 40 basis points, which means only about 40% of rate increases are captured in deposit products. So, I mean, there are specials that are being run, but you have to be careful about what the withdrawal and liquidity premiums or penalties might be if you don't meet the exact terms. But in any instance, whether you're talking about a deposit product, a money fund, some sort of a liquidity pool, you're looking at interest rates that will immediately, after the Fed's meeting today, adjust upwards by some number of basis points or, percentages.
The reason why I ask is because there is a question about what happens when cash is actually a true investment, a viable alternative in a way that it hasn't been for so long. And we have seen all of this retail engagement and investing in part because they weren't getting anything anywhere else and money was so free. How far away are we from that point?
Well, I think a terminal rate to look at right now, at least for the foreseeable future, is somewhere in that 2.5% to 3% range. And I think that probably comes within the next 12 months. Some people are calling for it by the end of the year. I think the Fed has not set us up appropriately yet for that being that quick of an environment that gets us there by the end of the year. But certainly, at the press conference today, Chair Powell will hopefully enlighten us a little bit about whether that's over the next, 6 or 7 months or more like the next 12 months. And then you get to a real rate that I think is, is meaningful.
Okay, so that's the more long term. Deborah Cunningham, in your space, do you have a terminal rate? Is there a terminal rate in the short paper market?
Right now, it's still, for the current time being, you're looking at a terminal rate that's probably, and over the next 3 months, somewhere in the 1.5% to 2% range. And then, as we get more guidance from Chair Powell and the rest of the FOMC members, maybe you begin to see that curve steepen a bit and get closer to the longer term rate.
In the short term space, in the cajillions of dollars, you're telling me there's a bear market, yield up, price down, even in the short term trust market.
For anything other than a stable net asset value product, that's absolutely the case. For the shortest maturities, and here you're looking at, maturities that are basically 60 days and under, then then you're not in that bear market.
And John, this is very important because it means a triple leveraged all cash fund's got some risk there to its
You're talking
yield.
your book, TK, just a little bit.
I'm sorry.
Triple leveraged, absolutely.
Yeah, well, thank you, Deborah. Nice of you to mention that.
Deborah on script. Deborah Cunningham of Federated Hermes. Deborah, thank you. Across a couple of things today, not just the Federal Reserve, but also some of these earnings stories too. Lyft after the close yesterday was just dreadful. The stock's down 26%. There's worries about their ability to attract talent, people in the labor force to get drivers and paying up for them. Uber was set to report after the close today. They've brought that forward. We're set to hear from them, Lisa, in about 5 minutes' time.
How much is this because perhaps they want to get ahead of all of the bad news that's getting baked into their shares, too, with a bit of sympathy declines there ahead of the market? Also, are people overpricing some of the risks to this particular field, given the fact you guys take Lyft, you guys take Uber? As people do more business travel, that's been a default for them. How much they actually get a boon ongoing from the reopening trade?
I'm not sure how big the market is for 4 a.m. business travel, but I take your point. TK's not going to keep doing business, that's for sure.
I think it's something that touches all of our listeners and viewers, either directly or, frankly, indirectly. It's a technological invention that they made a number of years ago. And it's, where's the beef? Where's the profit? And given there's shocks, but John, where's the profit model?
On a serious point, payrolls tomorrow, or rather Friday, 385K is the estimate. Citi actually think we come under that because people will struggle to find the workers. So this number is not going to be north of 400K for the likes of Citi and Andrew Hollenhorst. That's connected to this story in many ways. From New York, this is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What the Fed really needs to deliver is a bit of shock and awe.
What the market's going to care about the most is what are the odds of 75? And again, we think that Powell is not necessarily going to fan those flames.
Central banks, of course, were not expecting this inflation. They hadn't seen inflation for a long time.
I don't see how inflation comes down with the Fed funds rate on a still accommodative setting.
They're going to hope that they can tame inflation without killing off the business expansion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures, equities up 0.4% on the S&P. A Federal Reserve decision around the corner and potentially the biggest rate hike, Tom, going all the way back to the year 2000.
Really an historic day here. We're going to provide some leadership here. The lawyer Paul Romer will join us in the next hour, particularly with his expertise on technology. And speaking of technology, it's that overlay across all of the American economy, John. Part of that is the new, and the new is down in flames this morning with Lyft, and moments ago, Uber.
Lyft getting absolutely crushed. And Lisa, looking at Uber, you can see why they brought that earnings report forward from after the close to before the opening bell.
Right, and we sort of suspected this, that perhaps they wanted to get ahead of some of the sentiment from Lyft, basically saying that, look, we actually beat earnings estimates. They said that they see first quarter revenue coming out at $6.85 billion versus estimates of $6.13 billion, and then seeing second quarter adjusted EBITDA coming in at 240 to 270, basically the higher end versus the estimate of 247. Honestly, how much are they trying to distinguish themselves in saying that Lyft's disappointment was a Lyft story? Uber is a separate case. Shares pairing losses ahead of the open, but not as much as you might think.
The stock down about 3%. Clearly, there's an issue in the labour market for the likes of Lyft, but they're not alone, Tom. They are not alone. We've got all these job openings in America, millions, and people are struggling to fill those vacancies. And often people will say, if you want to fill them, you know what you've got to do? You've got to put wages up. It's the payrolls report on Friday.
It's almost an advantage to have this Lyft Uber debacle as we go into the Fed meeting, John, because the distinction we hear from market economists is simple. The job economy is the heart of the matter. It is on fire.
Do we have a supply side problem still? The answer to that, yes. As Lisa is yes. Later this year, do we solve it? Who knows?
Were we supposed to be solving it at this point? I mean, how do we have job openings still climbing? And some people are saying, well, they're not real job openings. Companies don't plan on hiring. And yet you are seeing all indications of salaries going up significantly. Again, I do wonder what the Fed is going to do with that JOLTS report from yesterday, showing job openings coming in at a new record high.
Let's whip through this price action for you. Counting it down to that Federal Reserve decision. And we hear from the president shortly after that Fed decision, which is a bit of a head-scratcher, to be quite honest. 0.4% on the S&P. Yields come in a basis point on a 10-year, 295.58, euro-dollar, just about positive. Really muted price action here, 105.29. Crude is positive by more than 3% on both WTI and Brent as well. Lisa, as Europe comes out with a plan to ban Russian crude.
To pay, maybe. They have a plan. They haven't passed it yet. So let's see how that actually goes. And it will be a 6-month ongoing ban. But as we've been talking about, and frankly, Maria Tadeo has really put out there so well, it's not about oil. It is all about gas. And without that, how much does this really change the narrative?
That's going to be the story. A little bit later, we'll catch up, Maria, in the next few hours or so. Over in Germany today, Tom, to break down the difficulties that the Europeans are having, making things maybe a little bit more painful for the Russians.
It seems to be working. I mean, there's some export numbers of Germany to Russia, which really indicate the effect here. And frankly, as we heard from Mr. Diamond of JP Morgan, it cuts both ways. And as he said, maybe the sanctions are bad for the West, but they're worse for Russia. It's a relative game of sanctions, and maybe we're having a relative conversation about what to do next.
Well, Tom, you know those banks on Wall Street have got their own problems, distinct from what is happening far away in Ukraine and Russia.
Yeah,
those stocks are down and down hard year to date, even with what's happening with the Federal Reserve. So when you hear the leadership at these banks turn around and say, the economy's strong, we can take it, I'm not scared of the Federal Reserve, the stocks aren't hearing that.
But there's selected stocks, John. I really take issue with bundling them all together. It's no different in technology. It's no different in consumer staples. There's a real separation out here of people down less than others are down.
We can do the year to date on JP Morgan. It's down more than 20%, Tom. On Goldman, we're down 17.75. Morgan Stanley down almost 15. Citi down 17. Bank of America down 16.5. It's pretty rough across the board, Lisa.
How much is this really about growth? Where are there nodes of growth at a time when investment banking is expected to slow down? You're going to see an increase in consumer defaults. You have all of these companies that have already locked in borrowing costs at such low rates. You start to see high-yield bond yields average at 7%. What company is going to want to refinance now if they don't have to?
Peter Oppenheimer is going to help us make some money. He joins us now, the Chief Global Equity Strategist at Goldman Sachs. Peter, there's a lot to fear, but the price of the story has changed a lot in the last 2 months as well. What are you suggesting to clients that they do right now?
Well, I think that, in the context of some of the things that market participants have had to absorb in the last couple of months, risk assets have held up reasonably well. Yes, there's been massive pain, particularly in unprofitable tech and very long duration assets, and equities have pulled back. But when you consider how much inflation and interest rate rises investors have had to absorb, the war in Europe and growing risks of recession, they've held up reasonably well. But market sentiment has become very negative. And I think unless we get a deep recession, there's a limit to how much equities will fall from here, particularly given still very negative real rates.
Peter, when you sum Goldman Sachs economics into your legendary equity universe, all the different people that you're linking with in the sell side, your research analysts and such, what inflation number do we get back to? German inflation is unspeakable. American inflation is a different unspeakable. But what level do we get back to out there?
Well, I think our view is, and indeed I think the central bank's view and the market's view is that at least some of this inflation is temporary and will start to ease, particularly in relation to commodity prices and some of the supply side constraints that we've been seeing. Core inflation, of course, has gone up, but less so in Europe than the US, and there's less tightness in the labor markets. But certainly, I think inflation is stabilizing in this cycle at a higher level than it did in the post-financial crisis era. And there's still a question, I think, about what the appropriate level of interest rates will be as we settle down at a lower level of inflation that we're seeing now, but a higher level than we've been seeing for many years, bearing in mind that real interest rates and nominal rates are still very low in the context of where inflation is likely to be. And I think that's tension is still a key focus for investors.
Peter, does all this add up to being a screaming bull? Basically, are you saying to Tom, get out of triple leverage all cash and go all in on Apple, on Amazon? I mean, is that basically what this translates into?
I wouldn't say we would be really bullish. We are bullish of equities on a relative basis. We've got reasonable upside into the modest double digits over the next 12 months in most equity markets, because we think some of the tensions that investors are clearly focusing on and some of the uncertainty about where rates will peak and how weak economies will be will start to fade over that period. But I do think it's important to also put things in context. We've had years of strongly rising performance in financial assets, in equities, largely as interest rates have just trended downwards, and that's not going to continue in this next cycle. So we would be looking at positive but lower index returns, and much more focus on alpha, much more differentiation beneath the index levels of equity markets within and across sectors.
Peter, can we get the banks trade to work? What do we need for that to work?
Well, the banks trade had started to work as you were starting to get a more reflationary dynamic priced in last year, and interest rates were beginning to pick up. Banks have strong balance sheets, and that was considered to be a positive, bearing in mind that valuations were low. But as you were reporting just before this conversation, banks are also very vulnerable to recessions. And if investors think there's going to be a recession and loan losses and credit write-downs, there's a rising risk premium you get because of that. But we should recognize that even as the risks to growth remain on the downside, the risks of a deep recession don't look that high. You've got strong private sector balance sheets, households, corporates, and banks. And so even as you get a slowdown in growth, the risks of systemic shocks that could be very negative to banks are more limited now than we were seeing, for example, around the financial crisis or other recessions. So I think selectively, banks are starting to offer some very good value, and particularly so in Europe, where we're overweight.
So you are more constructive on that. Are you just as constructive on your team playing Liverpool this Saturday?
I wish I could have as much confidence, but I have hope. Hope springs eternal.
Spurs, big game, Tom, at the weekend.
Player with Spurs, exactly.
Big game, TK. Fellow fan as well.
Yeah, well,
you share the same team.
I look at it and
Tom's got taste.
I start listening. I listen to Adele mostly when I get ready for Tots. She's
Is that what you do? Is that your hype song?
I listen to Adele and and try to
sing along.
Get a
Do you want to give us a little taste of it now, Tom? Just a flavour.
Hello.
Just which song? Is it Hello?
Yeah.
Is that the song?
No, it's one of the ones like with like a drum. I don't have it right in front of me right now.
All right, maybe next time.
I'll give it to you later, though, Jim.
I look forward to that. Peter, run. It's good to catch up, buddy, as always. Peter Oppenheimer there of Goldman Sachs. Thank you. Want to return back to that Lyft Uber story. Lyft after the close yesterday, struggling to find the talent, the drivers. They're going to have to pay up for it, provide incentives. Maybe a little bit evasive on the call. The stock down by about 26% in the pre-market. Uber had scheduled to bring their numbers out after the close today. They saw the damage and said, okay, let's bring ours forward. For good reason, the number's pretty terrific. And Dara Khosrowshahi, the CEO, saying the right thing in the statement when he said this: the driver base is at a post-pandemic high, and that he expects the engagement of drivers with their company to continue, quote, without significant incremental incentive investments, Tom. So maybe that's the difference between Uber and Lyft right now. Same problem, dealing with it maybe in different ways.
Well, the Lyft conference call was something. They said, we could have had it all. You're going to wish you never had met me.
Keep going.
Rolling in the
What's
deep.
Going on? What
Tears are going to fall.
Yeah.
Rolling in the deep. That's what Lyft said on the conference call.
I had no idea that today would be this emotional.
I know, it's true.
Futures up a third. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Federal Reserve Chair Jerome Powell is poised to unleash the central bank's most aggressive action to battle inflation in decades. Still, investors will be listening to what he says to see if even bigger moves are ahead. Policymakers are expected to raise interest rates by a half percentage point when their two-day meeting ends today. It would be the largest rate hike in more than 2 decades. The European Union is proposing to ban Russian crude oil over the next 6 months. European Commission President Ursula von der Leyen also said that refined Russian fuels would be banned by the end of the year. Bloomberg's learned that Hungary and Slovakia won't have to enforce the ban until the end of 2023. Both were opposed to a quick cutoff of Russian oil. In Ohio, a candidate backed by Donald Trump has won the Republican primary for a U.S. Senate seat. Venture capitalist J.D. Vance, once referred to as the former president as unfit, but now embracing him and his views. He defeated 6 other candidates. Trump endorsements will be tested in coming weeks with Republican primaries in a number of states. And Uber delivered an upbeat outlook for earnings in the current quarter. It was a signal the ride-hailing service plans to capitalize on robust ride demand without compromising profits. Uber plans to focus on product changes rather than incentives to deal with a driver shortage. All that contrasted with its rival Lyft, of course, which delivered a disappointing outlook on Tuesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
How high will the Fed go?
I have everything on the table right now.
25 or 50 basis points?
If we think it's appropriate.
It could be 25, it could be 50, it could be 75, it could be 1.
We'll tell you what you need to know.
It becomes a question of how fast and how far do they go with rates?
Does he choose to de-emphasize parts of this forecast?
I'm blown away by the conversations we're going to have.
We're going to discuss all of this coming up.
Bloomberg surveillance, the Fed decides. Today on Bloomberg, the fastest way to stay one step ahead.
The idea that just to 3% would be enough is really unlikely. I think they're going to have to raise interest rates to 4 or 5% to bring inflation down to 2.5 or 3%.
It's the big one today. We're looking for a 50 basis point move from this Federal Reserve. That was Ken Rogoff, the professor of economics and public policy at Harvard. From New York City this morning, good morning. This is Bloomberg Surveillance with futures up 0.4% on the S&P. On the Nasdaq 100, up 0.33%. Yields in a single basis point, 295.58. Euro dollar basically unchanged at 105.31. Europe has a plan to ban Russian crude. Crude is higher by 3.7% on WTI to a 106 handle. 106.15 TK ahead of the Fed a little bit later.
John, I want to stop here and talk about the unspoken, which is Chairman Powell faces dollar resiliency today. You're looking at DXY and BBDXY, the Bloomberg Dollar Index, off ever so fractionally. And John, this goes to what's domestically focused in Washington, which is there's another part to economic growth, and that's the export-import dynamic. John, that's a ginormous mystery for this Fed.
And Tom, I'm pleased you've brought up the trade balance because that was a big factor in what we saw in Q1 in the GDP print as well.
Yeah, it is, and inventories as well. But I'm just suggesting, folks, that the Fed chat is such a domestic chat, and there's more to an economic calculus than just the domestic angle. Anne-Marie Horton lives this every day in Washington, all domestic all the time. Anne-Marie, let's just digress here for a moment. The elections of last night, it's Wednesday, Tuesday yesterday. I don't want to play-by-play here. We don't have time for that. But is it a Washington shifted this morning, adapted, adjusted to what they observed in Ohio and Indiana yesterday?
Well, analysts remain and say that, listen, it's too early to tell. When you look at, especially at Ohio, when you have the J.D. Vance coming out on top, he got that key Trump endorsement when he was behind in the polls, and he beat 6 other individuals to win this primary election. And this, of course, is as everyone is speculating and wondering if, one, Trump can maintain this kingmaker-like status at the GOP, and two, his idea of flirting with running for president again. So that is definitely part of the conversation. But really, Tom, bigger part of the conversation when you're talking about any type of election today and what will be the main driver of the next couple of weeks is obviously how abortion plays into the upcoming elections, because that will now be a hot topic item, and whether or not that is going to eclipse things like inflation, what voters care about.
You mentioned in all of our conversations, you more than anyone I know, Anne-Marie, always drift back to the senator from West Virginia. The president speaks today, and frankly, Chairman Powell speaks separately today. How will the gentleman from West Virginia treat that angle, that new attack by Mr. Biden?
Yeah, going to be dueling press conferences, if you will, both talking about the economy. So potentially President Biden is going to be, as Josh Wingrove put it, offering an olive branch to Senator Manchin when he talks about deficit reduction, and actually the fact that the Treasury has just made revisions on it and there'll be a bigger deficit reduction. And then he's going to pivot and talk about the fact that inflation is still high. We do have this deficit reduction. The administration is winding down on some of this emergency spending, but there are places where they they can make long-term investments to bring long-term inflation down. You think of things like prescription drugs, which the president knows the public is on his side. So that is his speech today. The timing, of course, is interesting. Is it potentially to duel Jay Powell, or is this just to have a day focused on eco in Washington? The timing is a little bit curious, I would say.
Anne-Marie, before we let you go, you were at the White House Correspondents' Dinner. We all were, and there are a number of cases of COVID rolling in as far as the diagnostics. Trevor Noah was joking about how it's a super spreader event, and we have heard that an ABC journalist who shook hands with the president was diagnosed with COVID. How concerned are people about the potential exposure of Joe Biden and how he's insulated from getting sick?
Yeah, that ABC journalist also sat next to Kim Kardashian, who went to the Met Gala. So, as Trevor Noah said, the most distinguished super spreader event potentially we were all in attendance with. Listen, the administration knows that the president potentially is going to be exposed. They're taking every precaution they can with the president, but we should note he was also exposed to Speaker Pelosi. Everyone remembers that peck on the cheek, and he didn't contract COVID-19. His vice president, she spoke last night about abortion after she tested negative. She's back out in front of the cameras. Obviously, the president is going to be exposed to people, but they're doing everything they can. They're also planning for what it would mean, which is the fact that he would just work from the residence and have that all set up.
Things we all want to know. Did Kim spill a drink on that dress? Did that happen?
I don't know. I don't have firsthand report. I don't have firsthand
That's the
reporting
report,
on
and
that.
I wanted to know. It's a $5 million dress, Tom. Real deal.
Oof, yeah, it was.
Marilyn Monroe.
It also links back to Washington, because remember that dress is the dress Marilyn Monroe wore when she sang "Happy Birthday" to JFK. So
Happy birthday, Mr. President. It is that dress,
Yeah.
Tom.
Oh no, Tom's going to sing that.
Anne-Marie or Dan?
Don't do it.
Dan in DC.
No, I'm
do
gonna
you
wear
want to
the
sing us a
dress.
tune, Tom? I don't
do
know if
that
you can
either.
squeeze into that dress, TK. Apparently, she had to lose 15 pounds or something. Something
Yeah.
like that. I know way too much about this.
I know, I was about to say news you can use.
Yeah, and maybe revealing too much. Just a general interest in the Met Gala, Tom. To Anne-Marie's point, just, to follow whether
Bring it
people were
back.
exposed to COVID or not and all those good things.
Way to bring it back.
When are we going to stop doing this?
That's a good question. Honestly, I think that we're getting to a point where people have more fear of missing out than they do fear of getting sick, and that's why you're seeing these events, regardless of the COVID fear.
Well, there's 29,793 last night to watch the Red Sox take out Thor and the Los Angeles Angels. Is that any different than the White House dinner?
The idea is better ventilation, it's outdoors, Tom, all of that stuff. I mean, my question is, when are we going to stop testing for this? If you believe that it has developed into something that is no longer of the concern that it was a couple of years ago, how far away are we from just treating this like every other thing?
I have yet to hear a medical professional suggest that, John. We're not there yet.
Closer, though, Tom.
Yes, but I don't have a timeline on that in any way, shape, or form. The medical professionals say the virulence is tangible, and to be very clear, even with 300-some deaths a day, which is a miracle, we're nowhere near that run rate of 150, 160, 170, which is flu-like. And again, I don't hear them talking or considering, John, when we stop testing.
Bramo is in charge of track and trace for us here, TK.
Am I? Well, yeah, I'm working hard. I've got a little, flow sheet.
Futures up 0.5% on the S&P, and the Nasdaq up 0.4%. Coming up a little bit later, a Fed decision at 2 p.m. Eastern time. And then you'll hear from the President of the United States. I mean, Anne-Marie used the word curious. Tom called it clumsy. I'll let you choose your own word. No idea if he turns up on time either. And then at 2:30 Eastern, you'll hear from the Chairman of the Federal Reserve. So an interesting day ahead for all of us. Yields coming a basis point or two, 295.58 on a 10-year. I'll talk about that in just a moment. From New York, this is Bloomberg.
Harcourts has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance on TV and radio, and here's your price action. Equity futures doing okay here, up 0.5% on the S&P, on the Nasdaq, up by 0.5% as well. Quite a change from a couple of months ago. We've done this a few times this morning already. Let's do it again. On March 16th at the close, your bond market did not look like this. It was at 194 on the front end on twos, 218 on a 10-year, and right now your 2-year is at 279.50, very close to the highs of the year. We saw that print through 280 a little bit earlier on today. 295.97 on a US 10-year after breaching 3% briefly over the last week or so. So that's a big change, and I want to talk about the change we could still get at the front end and use the work of Nomura to go through that. Nomura think 50 basis points today, 75 basis points in June, 75 basis points in July, and they see this Fed funds rate at 4% by the middle of 2023. TK Nomura are taking a very, very different view of things at the moment. They think a more aggressive Fed coming out of this one and into next year.
Well, it is. It's nonlinear. We're going to talk about that in a moment here with Greg Staples. But, John, I can't convey enough. And Diamond talked about this static analysis versus dynamic analysis. And the fact is there's massive nonlinearities after this meeting.
What is the scope for surprise in this news conference? Bramo, it's going to be very difficult to reflect the consensus that does not exist about the future on this committee. The committee is ready to get back to what many of them think is neutral, 2.5% on Fed funds. After that, the future, there is division. And the question that a lot of people are waiting for in this news conference is a question about a 75 basis point hike. For the likes of Morgan Stanley, Bank of America and others, very, very little scope for surprise on the hawkish side today, because where is it going to come from if this is a market already primed for such an aggressive front-loaded view through the next few months?
The only place that a big surprise could come from is a response to a question about whether they think it's important, the Fed, to get back to 2.5% or 2% inflation quickly. If they think that that's the case, you might see a hawkish surprise. Otherwise, it seems like a lot's been baked in.
That's the view in the bond market. Here's the view in the oil market, just briefly. WTI and Brent this morning, higher by about 4% across the board here, off the back of an EU plan to finally ban Russian oil. A plan, because this one is going to take some time. And Lisa, it's going to be phased in. Is phased in the language they would like us to use?
Well, honestly, they probably want us to say it's a harsh ban so that they can get the political support as actually taking a hard line on Russia, but phased in is probably the accurate way to frame it, John.
Brent Crude, 109. That's the cross-asset price action. Let's get you some single names, some movers. There are many. Let's say good morning to Crudy Gupta. Morning, Crudy.
Yeah, good morning, John. Let's start off with one of the biggest movers to the downside this morning. That, of course, is going to be Lyft shares. They did come out with a weaker than expected outlook, but they also said, and this is really what really kind of made the stock suffer, is that planned increase increase in driver costs. Remember, they're trying to retain talent here. So not only are they paying more to their drivers, but they're also providing fuel subsidies. That's the theme you're going to see in Uber as well. Uber actually moved their earnings from after the bell to the pre-market. They came out, they beat expectations in their outlook, and they addressed the concerns that are weighing on Lyft shares right now. They said that actually those driver costs is not going to impact their bottom line, not going to impact their outlook, that they can weather the storm. So really learning the lessons from Lyft. And you can see that 5% drop in Uber that was happening at about 6:30 a.m. this morning. The stock has since stabilized and even briefly turned positive. So we're going to keep an eye on that dynamic between Lyft and Uber. But let's stick with the growth picture, the outlook picture, because that's really what's supporting Airbnb shares this morning, up about 5%. This comes after a very strong second quarter forecast saying that that's sustained travel demand after 2 years. They're expecting that to continue. People want to get out there. They want to travel. And if you actually talk about the growth picture broadly, the best case study for this is going to be Starbucks shares. That's a company that's actually rallying quite a bit. So you do see Starbucks shares up 6.4%. This comes despite them suspending third quarter, fourth quarter guidance. They're saying less visibility in China, but very strong growth in the United States. So strong, in fact, that they're talking about accelerating their growth, their store growth here, making a lot of them drive-throughs, really embracing the technological advances that they were kind of forced to embrace during the pandemic. There are some downside stories, though. Akamai, we'll get to that in a second, but Advanced Micro Devices actually doing very, very well this morning. A lot of this coming from very strong data center growth. Once again, that technology story working well this morning. But Akamai, which is a software company, well, they said that they're actually very concerned about the effects from the war in Ukraine and simply the supply costs that you're going to see. So Akamai is going to be your biggest downside mover, down some 14%.
Crudy, thank you so much. This afternoon, Priya Misra, among others, will be with us on fixed income, but this is the interview of the day on yield. Gregory Staples has decades of work here at DWS Group, is head of fixed income North America, with a brilliant note of what is next. Greg, thank you for joining us. Bloomberg Total Return Index, full faith and credit, negative 11%. Credit market, which Lisa looks at, negative 14, negative 15%. Jerome Powell is crushing bonds, isn't he?
He's absolutely crushing bonds. But the good thing is we haven't had that kind of volatility that often happens when the Fed removes liquidity from the marketplace. No breakdown in subprime, no dot-com stock crash. It's been fairly controlled so far.
Okay, it's
and that's
been
a good
fairly
thing.
controlled so far, but this is important. If you forget about the mathiness here, if I'm going from a Gaussian analysis to log normal, or I've got greater shocks on the downside, that is to come. What is the when of that? When does it get away from the stability of path that we've seen?
I think it would take something from the Fed saying that we haven't gone enough, fast enough, but I actually don't see that happening. I think he's going to continue to guide interest rates slightly higher. We might actually be closer to the peak in rates for 2022 than we are to the bottom. Today will certainly tell, but this is not a Fed that wants to do shock and awe. This is a Fed that wants to control the marketplace, let the medicine take hold. And for the past 3 months, it has. I mean, I think we've seen potentially some indications of a slowdown in the economy. Oil prices seem to have leveled off. We saw ISM weaker last week. We're seeing mortgage applications start to turn down. We've seen some of the frothiness taken out of the securities markets. It's what you'd want to see happen after 3 or 4 months of indicated monetary policy tightening.
One thing that you pointed out, Greg, was that you do not think that the declines that we've seen so far in equities and frankly even in bonds will get the attention of the Fed as something of a concern. How far would the sell-off have to go, both in stocks and bonds, before the Fed takes notice and re-engages with some sort of put?
You're actually bringing out the point of the Powell put, which I think people have talked about a long time. I think the market's unfortunately been trained that anytime there's a severe downturn in the equity markets, the Fed will step in and provide support there. And I think we still have a ways to go here. We're down, 8% last month, 10 or 12%, depending on your index so far for 2022. I think you would have to see another, 8 or 10%, and it would have to be a real sharp decline rather than something that's easing down. The Fed looks at the equity markets very, very closely. They don't want to destabilize them, but I think they're looking at it as a signal both that the economy is starting to slow down and that their policy actions are starting to take hold.
There is an issue of linearity that Tom talks about, that there's one aspect of this controlled weakening in markets, but that all at once that can change, especially as they actually do start reducing the balance sheet, which they may do at today's meeting. How concerned are you about that, about an uncontrolled move in response to what the Fed is doing when they actually engage with it rather than just jawbone?
It's certainly a risk, but we don't see it. We don't see the buildup in pressures like we saw in some of the past cycles. I mean, the Fed is always concerned when they're in their financial stability report about frothiness in some of the securities markets, and some of that is already eased out. It's as if you will, the bubbles leaked a little bit, and so the risk of it popping is not something that we see. It's always a potential out there. There might be some built-up pressures, but we can't find them, and we don't think they're there.
Let me ask you, Financial TV 101. How can we be quiescent, as Greenspan would say, about bond prices coming down a little more and holding still and yields holding if the Fed is raising rates along the way? Those two don't match, do they?
Well, they do, actually, because I think the bond market does a very good job of discounting the forward path of Fed actions. And right now, I think they're probably close to the end of it.
So to be careful here, I'm getting the dates up, John. At the September 21 meeting, the bond market's going to be modeling in late 2023.
That's probably right.
And what do you see for late 2023?
I think in the short end, you're probably talking 2.5, 2 3/4. I don't think it goes much further than that. I do think that what the Fed's done so far, or at least what the market's doing for the Fed, will actually start to bite in the economy. I don't think that, but actually have to remember, Tom, that this is also an election year, and one of the reasons we're talking 50 basis points in May, June, and July, it's fortunate for the Fed they've got consecutive meetings like this, is that they can pull back and go on autopilot before the November elections. This is the first time I can remember in history when the administration is not screaming for looser money in an election year. If anything, I think they're quiescent for neutral or tighter money. That's historically an anomaly.
John, I was trying to get Staples in trouble there. I think
Craig's experienced enough to stay out of trouble, Tom.
Yeah, he killed it.
Greg Staples there of DWS Group. A question that Deutsche Bank asked, given how strong consumer balance sheets are in the eyes of so many people, including Greg Staples, how sensitive is demand to rate increases because of all of that, Lisa? And I just wonder whether maybe that's another factor why some people think rates do not actually have to go even higher.
I think that that's a really important point, and it's not just the consumer, it's also corporations that have locked in financing for so long. If they don't actually have to incur those higher charges to borrow money, does it really have a tightening effect on the market? And this is a really important point in terms of how long we have to wait before Fed policy actually makes a material dent in the U.S. economy.
Here's a stat for you. Citi just published 1.94 job openings for every unemployment individual shows an even tighter labor market. This, together with a 1.4% quarter-on-quarter employment cost index, should keep pressure on the Fed to address inflation and imply a balance of risk that skews hawkish at today's Fed meeting. Lisa, I actually saw you tweet that number this morning from Jim Reed over at Deutsche Bank too. 1.94 job openings for every unemployed individual in America right now. That's quite a number.
It's unprecedented on every level. It has led some people to wonder whether that's an accurate stat in terms of actual job openings or simply those that are posted. I do wonder whether that JOLTS report gets the Fed's attention because it just highlights that we are increasing in tightness, not exactly remedying the issue.
Well, we know the ECI gets Chairman Powell's attention, don't we?
Yeah, we do know that. Yes, that was what...
that was the major data point behind the pivot and not the second term.
No skepticism
that he secured at the Federal Reserve.
How do you feel about
How
this?
do I feel?
Yeah.
Oh, no. I like to stay neutral on these stories.
Yeah, you're as neutral as can be.
I just don't want to give my opinion on why Chairman Powell got his pivot and when he delivered his pivot. It was interesting that it came around the time that he got a second term. Futures up 0.5% on the S&P, the Nasdaq up 0.4%. From New York this morning, good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Fed set to unleash its biggest interest rate hike in more than 2 decades. Policymakers are expected to wrap up their 2-day meeting today by agreeing on a 0.5 percentage point increase. They're also likely to announce plans to shrink the Fed's nearly $9 trillion balance sheet. Russia is focused on cementing both military and political control over the Ukrainian territory it has taken so far. The Kremlin is installing occupation governments and has ordered locals to use rubles for transactions. Bloomberg's learned there will also be referendums in some areas to open the way for full annexation. In the UK, financial services workers are getting pay hikes at twice the rate of the rest of the population. That's widening the gap between the rich and the poor. According to the Institute for Fiscal Studies, average monthly pay in finance was 31% higher in February than at the end of 2019, above the 14% prevailing across all sectors. CVS raised its outlook for the year and posted first quarter results that beat estimates. The drugstore's chain largest business, pharmacy benefits, reported revenue that was almost 9% higher than a year ago. Meanwhile, sales at the CVS health insurance business was up some 13%. Starbucks operations in the U.S. beat expectations in the latest quarter. That was a welcome development to interim CEO Howard Schultz. He has to contend with high inflation and COVID measures in China that have hurt the performance over there. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Fed is going to have to raise rates and reverse QE. And they're going to, if they can, they're going to try to slow down the economy enough so that 8% starts to come down over time. So I think people should take a deep breath, give them a chance, and I think they're going to move. I think the sooner they move, the better.
Deep breath and give them a chance. The words of Jamie Dimon, the chairman and CEO of JP Morgan from New York City this morning. Good morning with Tom Keene, Lisa Bramberts and Jonathan Ferro. Here's the price action in the equity market, up 0.4 on the S&P and the Nasdaq, up 0.4% also going into this Fed decision a little bit later. Yields come in a couple of basis points, 295.19. Do you think that's what Chairman Powell's going to say to Mike McKee later, Tom? Deep breath. Give us a chance.
Yeah, well, I think it's going to be there, but I think what's interesting is sort of out of the zeitgeist is to see where the dissent is today as well. And I guess is to what we just heard from Greg Staples is to the hawkish twist of 75 basis points. You really think, John, we're going to see outright dissent where people almost like
Tom.
Bank of England?
I would say it's more likely down the road than today. You never know. I think there is agreement on moving 50 today. Going through all the Fed speak, there seems to be a pretty decent consensus on making that move. Then things get more interesting. We know where the consensus is.
Well,
we also know where the division is. The division is about how far you go once you get to, say, 2%. You know where Jim Bullard would want that rate, Tom. He wants it closer to 3, and he wants it pretty quickly.
Yeah, it's going to be interesting to see. And again, our coverage at 1 p.m., folks, we begin with Matthew Lazzetti of Deutsche Bank with a recession call, the vice chairman. Alan Blinder will join us from Princeton. John, we have David Blanchflower at Dartmouth as well, don't we?
Do we? I didn't know that.
I think so.
I believe so, yes.
Very
I don't
cool.
have it in front of me.
Looking forward to that.
It's going to be a terrific set.
I can predict what Danny's going to say, but I'm looking forward to that.
Yeah, well, we're going to see. Right now, we're going to digress to the issue of the moment, which has riveted America. And what we do at Surveillance, as we've done with Ukraine, as we've done with COVID, is literally find legit experts. That would be Elaine Camargue. She's senior fellow at the Brookings Institute. Yes, professor at Harvard, but far more. She is a student of presidential success and failure. And a book of a number of years ago, The End of Government as We Know It, Making Public Policy Work. Elaine, you wrote a definitive essay, I thought very balanced, for Brookings yesterday on this raging debate of abortion. And at the end of it, you predict, off of the mass experience of COVID, a tsunami of fury. When does the tsunami hit?
Hello, and thank you for having me. The tsunami hit yesterday. Look, it hit last night with the demonstrations outside the Supreme Court. I think these will continue, and I think what it's going to do is going to increase turnout for the midterm elections. So a sleepy and kind of indifferent Democratic electorate, I think, has gotten a big wake-up call, and I think people are going to come out to vote in November, perhaps even upending some of those elections, which we were assuming was going to go to the Republicans.
Elaine, Linda Greenhouse, among others, have walked through the Mississippi Circuit approach and what the Supreme Court traditionally has done. Is any of that nuance going to matter in this debate, or is it so polarized and each and every American so decisive of their choice on the choice of abortion that all the niceties really don't matter?
It's an interesting question, because part of what we're going to wait and see is how this, in fact, plays out. There will be states that will still offer abortion, but at 6 weeks or at 15 weeks. Okay, so, this doesn't mean automatically abortion disappears everywhere. And the more interesting thing that's been happening is, while attention has been focused on the states getting rid of abortion, there are other states like Maryland, Connecticut, Oregon, who are increasing their abortion workforce. They are allowing non-doctors, other health professionals like nurse practitioners, to perform abortions. They are getting ready for the abortion influx. So people are going to be traveling to get abortions. Abortions will not be prohibited. People will be traveling, as your map shows. Some will have to travel very far. And this is going to, like all things, it will have a small effect on the well-educated and people with money. And it's going to have a big effect on poor women who can't afford to travel or who can't even get the information about traveling. So it's going to have a very disparate effect. But we will have abortion-providing states and abortion-banned states.
There's a question about how this transforms the election heading into the midterms. A lot of people saying that this was leaked in part in order to galvanize voters. There's a lot of speculation on all sides. Putting all that aside, do you think that this fundamentally reshapes the Democrats' chance of actually being a little bit more successful in the midterms?
I think it does. I think it's a fundamental reshaping, particularly in the Senate. Okay, I think that the Senate races, because they're statewide races as opposed to districts drawn for one party or the other, I think this fundamentally increases the Democrats' chances of holding the Senate. I think there's going to be real outrage at just the interference here in people's lives. And the irony is that many of the same people advocating this rather draconian choice about what women should do with their bodies were also the same people who were arguing for medical choice and medical freedom when it came to whether or not they got a COVID test or a COVID shot. So this is going to really get people riled up. It has already. I think it will continue to rile people up all the way through November.
Elaine, wonderful to hear from you this morning. Thank you. Elaine Kmark there of the Brookings Institution. Something perhaps we haven't spent a lot of time thinking about, Lisa, through much of this year, because through much of this year, it was just seen as inevitable that we'd get this big swing in the midterms later this year.
And a lot of people basically counted out certain fiscal response to what we're seeing with supply chains, et cetera, because it was just not going to get passed given a divided House. And I do wonder whether this shifts this at all, given the fact that there does seem to be more voter turnout, and it might favor the Democrats more than it would have perhaps in the past.
First and foremost, sensitive to the nature of the discussion, but coming back to what we do here, looking at the market, too early to think about market implications of a shift in the midterms at this point?
It's never too early to think about market implications. It's a forward-looking exercise. I do think, however, what that response will be in terms of what will get passed, given the fact that the uncertainty right now, the band of uncertainty around inflation and basic economic growth is so wide, it seems to be a little bit difficult for me to get my head around.
Very little uncertainty, it seems, on what you can expect from the Federal Reserve a little bit later at 2 p.m. Eastern time. Most people expecting a 50 basis point interest rate hike. Then it's on to the news conference at 2:30 Eastern time and what Chairman Powell's going to do and how he deals with questions about the future. Futures right now, positive 0.4% on the S&P, on the Nasdaq 100, up nicely, up 1/3% as well. Yields on a 10-year down about a basis point, but we have had a little look at 3% this week already. 295.58 on a 10-year. And I know you're laser focused on this one, Tom. Euro dollar 105.
Yeah, I'm going to watch currency. I'm sorry, John, off this conference. And I think he's got to go to the job economy and talk about how hot it is, the JOLT survey and all that. But I'm going to, if I get a DXY breakout, stronger dollar, that tells a different story than the quiet I feel right now.
He said something like the labor market is almost too strong. And Deutsche Bank and others are asking, okay, if you believe that, if you want to rebalance labor market imbalances, can you do that without a recession?
I don't.
It's going to be tough.
Again, I'm going to go back to wage inflation, and that's where they become data dependent.
Futures up 0.4% on the S&P. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus Omicron variant still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Different environment where the Fed is trying to get to neutral much more quickly.
I think that the Fed wants to stop being a source of volatility.
How aggressive these central banks are expected to be over the course of the next year has to increase those recession risks.
You look across the globe, global forecasts for growth are being revised down.
It's clear that things are way out of control.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A Fed day on radio, on television. We continue our coverage. In this hour, the laureate Paul Romer and John Romer will deal with technology in this most unusual cycle for Jerome Powell.
What a difficult time for them, and some might argue they got themselves into it. This is what we're looking forward to today. A 50 basis point move. Overwhelmingly, that's the consensus view. And then from there, things get a little bit more interesting, complex. And that's why a lot of people think today it's going to be difficult for this Fed to out-hawk expectations because market expectations are very front-loaded right now, where there is division at the Fed. And what could be interesting for this market is any assessment about the future, the rate path, and what he thinks is going to happen with this economy.
And what's interesting is Peter Bookvar, publishing moments ago, John, talks about, yes, it's historic, but also uneventful. I'm not so sure. I believe the last time I was humbled in that there was a lot that went on.
A lot of people want to know the answer to the 75 basis point question, not for this meeting, but for the next few meetings. How he answers that, I'm not suggesting he will do that, but how he answers that, a lot of people will look for that answer and the hints that lie in it about what it could mean for the future path.
And Lisa, all of us, of course, folding into an America, and you mentioned it earlier, Lisa, what a different economy. Hotzius, among others, nailing it. It is a superheated labor economy.
I can't get over the fact, and John was talking about this earlier, there are nearly 2 open job openings, I should say, for every unemployed American, that is not going down, that ratio. And this is concerning, and it should be concerning to the Fed, and they are going to represent this. How do they then view their need to get back to a 2.5% inflation rate? Because honestly, it does seem like they would have to go faster in order to get back quickly. Does it matter to them to do that?
To open up the conversation here, Lisa, let me start with you. Instead of a 3.5% surveyed unemployment rate, do we need to begin to model a 2.9% jobless rate?
Right. And what does that mean if you don't get participation rate back up? Do we really even understand the dynamics of a market?
No, that's it.
That Fed Chair Jay Powell himself has said looks overheated. If it's overheated, and John was mentioning this, you were mentioning this, what do we have to do to get it back to a place that's more comfortable?
John, what does the financial system do with a fully employed 2.9% America?
So let's talk about the labour market, Tom, and work out what it means for this Fed. Typically, when unemployment starts going higher, things get bad. You don't get a pickup in unemployment and things turn out okay. These are the Fed's forecasts. So you said a 3.5. That's a survey for Friday, right? The Fed's at 3.5 year-end on unemployment this year. They're at 3.5% on unemployment year-end next year, and at 3.6% year-end 2024. A lot of people, Tom, think that's fantasy land. Diane Swonk, Scott Minerd could not make sense of those forecasts the last time they were on the program with us back on March 16th. We'll catch up with them again later. But that's what people are focused on. If you think there are imbalances in this labour market that are generating cost pressure and all of the above, and we're risking a wage price spiral, whatever that means, then if you want to rebalance that labour market, can you do that without causing a recession? That's where this soft landing, hard landing debate comes into it.
I'm going to tear up here, folks. I mean, John just nailed that analysis. He just killed it. That was on the edge of Scott Minerd. Futures up 17. John, I'm looking at a VIX well under 30. I mean, I'm sorry. Equities have had a little bit of a rebound.
Are you going to start singing a Gallagher?
I knew that was going to come.
Get emotional on this Fed
emotional.
day. Futures up 0.4%. I'm done. Yields down 2 basis points. 295.39 on 10s. I'll catch up with you at 8:30 Eastern time. I'm done for the next 20 minutes. Carry on.
Okay, you do a data check from 900 on to 959. We'll all be happy. Here's what we're going to do. We're going to try to recalibrate what the strategy is for investment given this Fed day. We do this with Megan Hornman, Chief Investment Officer, Verdance Capital Advisors, where they actually, I'm sorry, folks, they like actually manage money. Megan, good morning as well. 60-40 seems so dated. I'm in a bond bear market. My 40% is getting hammered. Selected parts of my equity market are getting hammered. Am I 60-40 or am I hiding under the desk?
I think what you need to do is, first of all, having dry powder coming into this year was extremely important, because while we have seen this 60-40 completely deteriorate this year, we also think that there are some ways to kind of readjust your portfolio. You've got to have alternatives in the portfolio, whether that be through real assets on the private side. If you're a qualified investor, they're going to help your portfolio, but also be flexible, be willing to make some adjustments within that 60% equity exposure. Look at those areas that have really priced in the worst case scenario.
What is your team telling people enjoying the great deluge, the flood of price down in bonds? These numbers are amazing, whether it's full faith and credit, true credit, or high yield, it's priced down. Have they ever experienced a bond bear market like this?
Yeah, I mean, this is obviously this is one of the worst bear markets in bonds that we've seen since the 1980s. So it is a lot for clients to stomach. What we've been doing is very short duration, defensive. We've been very careful with the credit space because we've started to see weakness there. So we haven't really had a lot of exposure in high yield and very little, if any, exposure in investment grade. Not to say there won't be opportunities back in those areas, but right now they're still in the midst of repricing this whole interest rate environment.
So Megan, you talked about how you started the year with some dry powder, with some liquid assets to try to deploy, particularly when you see some opportunities. Is this a buying opportunity? And it sounds like not yet, at least in the riskier credit sphere. So what are you looking for to determine that?
So not yet in fixed income. I agree completely there within fixed income. Stay short duration, defensive when it comes to credit. We're looking at investment grade. We'll look at high yield, but they're not cheap enough yet. We've seen this massive repricing in fixed income. Just at the end of last year, we had $14 trillion of negative yielding debt. Now we only have 2 around the world. So this is a massive repricing in fixed income. Be careful there. From an equity exposure, there are areas of the equity market, the global equity market, that have priced in what we think is the worst case scenario. When you look at things like small cap and mid cap stocks here in the US, down 20, 30%. These types of areas show, if you have the ability to look through short periods of volatility, that these will be good for the long run. International stocks, a similar situation. You got to stomach the volatility this year, but I think long term that they will end up being a good opportunity.
What about the U.S. versus Europe? We were speaking with Peter Oppenheimer of Goldman Sachs earlier, and he likes European banks. He actually sees some deals there. Do you agree?
Yes, we do like European equities, not just from the banking perspective, but also keep in mind that the European economies are much bigger exporters than we are. And right now, that's what the world needs. We still are working through a global supply chain complete collapse, and these European companies are much more export driven. They should help benefit as we continue to clear that up.
Megan, thank you for joining us today to break some of that down. Megan Horniman there of Verdant's Capital Advisors. Europe has been a tough place to be. What did the joke used to be? The way to become a millionaire is start out a billionaire and buy an airline? Yeah. Isn't that the old joke?
Yeah, I think that
replace that with European banks over the last 10 years.
I looked
Some of those names have just been rough.
John, I looked yesterday, and it's shocking to see it. And as Mr. Diamond mentioned, actually, on a relative basis here, it's ever more shocking. John, I think one thing that's underplayed here, you mentioned it earlier, Brent crude, a 109.49. There it is. It just hit a 50, rounded up to 110 if you want to be a little aggressive. Oil with a lift. And this diesel story that our Javier Blas has really emphasized, John, maybe Powell brings it up. I don't know. American diesel, 508 to 543 from the Fed meeting, and it's nothing compared to the upset in Europe. This is micro data that I'm going to suggest matters.
Hey, Tom, I couldn't agree more. I was so happy. I got some friendly criticism the other day, and they were so right to message me about this. Stop quoting crude, because that's not what people consume. Let's start talking about diesel, Tom. Daily gas prices, the average gas price in America is still really elevated. That is where the pain is for so many people.
Major shout out to one Stephen Shork of Philadelphia, the Shork Report. I mean, Steve Shork's analysis, John, is about 80% in his memos distillates. And I don't understand the chemistry of it. I flunked that. But the idea here of diesel is a foundation and bedrock, I might point out, also more efficient than gasoline. But the answer is diesel is way under discussed in the media, where it's front and center right now with the pros.
You touched on gasoline just there. Lisa, daily national average gasoline prices, $4.20 a gallon.
Yeah, and
it's still up there.
It's still up there, and it's back on the rise, too. It had been very high, came down a little bit, now going back up, and this really is meaningful if you're going to the gas station and suddenly it costs $100 to fill up your tank. At what point, though, how much does this color the view of inflation, right? The idea that this is typically something that's transient, and I hate to use that word, but I'm using it, and people usually look past this. This is volatile. But is this volatile on the way up because of how tight the supplies are for a longer period of time? How does that reset how we value energy as a component of inflation?
Tom?
I just think the micro data may slip out today from Chairman Powell. And John, one way it may is a discussion of CPI, of inflation, of the deflator. And there's been times in previous meetings, maybe not recently, where he goes to the Dallas trimmed inflation statistic, or maybe he'll use Cleveland. How do those inflation numbers come back when you've got hydrocarbons doing what they're doing?
He should just do
We haven't even talked about rent.
What you do in the news conference, we're going to be data dependent.
Yeah.
We're going to be data dependent.
Well,
and then someone will ask, well, haven't you ignored
John,
the data over the last 9 months?
We may get a snooze fest, but I just don't feel it. I'm sorry, I'm trying to sell this thing at 1 p.m.
Is that what you're trying to do?
You don't feel it? The snooze fest?
No, I don't feel it's a snooze fest.
What, the show or the news conference?
Both, you know.
Okay. Well, I hope the show's not.
Well, yeah.
I can't control the news conference. Mike McKee will do his best.
I mean, John, we could have had it all.
We could have. What's the next line?
Rolling.
Isn't it just that again?
Tears are going to fall. If it's a snooze fest, tears are going to fall.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Fed Chair Jerome Powell is poised to unleash the central bank's most aggressive action to battle inflation in decades. Still, investors will be listening to what he says to see if even bigger moves are ahead. Policymakers are expected to raise interest rates by a half percentage point when their two-day meeting ends today. It would be the largest rate hike in more than 2 decades. The European Union is proposing to ban Russian crude oil over the next 6 months. European Commission President Ursula von der Leyen also said that refined Russian fuels would be banned by the end of the year. Bloomberg's learned that Hungary and Slovakia won't have to enforce the ban until the end of 2023. Both were opposed to a quick cutoff of Russian oil. In Ohio, a candidate backed by Donald Trump has won the Republican primary for a U.S. Senate seat. Venture capitalist J.D. Vance, once referred to as the former prime minister as unfit, but now embracing him and his views. He defeated 6 other candidates. Trump endorsements will be tested in coming weeks with Republican primaries in a number of seats. Uber delivered an upbeat outlook for earnings in the current quarter. It was the signal the ride-hailing service plans to capitalize on what's been robust ride demand without compromising on profits. Uber plans to focus on product changes rather than incentives to deal with a driver shortage. All that contrasted with its rival Lyft, which delivered a disappointing outlook on Tuesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its 2 biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
A bit of data in the United States of America. It's the preamble to the payrolls report on Friday. Called it the appetizer, the ADP report. Downside surprise. Mike McKee's going to break it down. Morning, Mike.
Good morning, John. Yeah, a bit of a downside surprise, and a little surprising given what we have seen from ADP in recent months. Only 247,000 jobs is what they think were added to private sector payrolls during the month of April. And the odd note is small businesses, they say, lost 120,000 jobs. The large businesses added 321,000, so combined with medium, you get that 247. But I'm not sure 120,000 business jobs went away. That is an interesting statistic. We watch leisure and hospitality, 77,000 jobs added, and then in manufacturing, 25,000 jobs added. And of course, this is ADP, so it comes with the caveat of it doesn't really track the April non-farm payrolls number very well, but it does get traded. So
I like that, Mike. It comes with a caveat. It's ADP, and that's the caveat. Citi said this coming into the payrolls report, Mike. I wonder what you think of this line. A shrinking pool of available workers should soon start to limit the monthly pace of job growth. We expect a somewhat softer 360K added in April. What do you make of that line, Mike?
I think that's probably true. We do seem to be reaching the end of the available worker, unless we get a lot of people coming back into the labor force. We've had some, but does it really continue? We saw the JOLTS numbers out yesterday, 11.5 million open jobs. That just keeps getting bigger.
Right.
So I'm not sure why we lost 120,000 unless people went from small companies to big companies, because they'll get paid more.
Michael, people flunk economic exams, not that I would know that, by the complexities of your labor economy analysis. There's a lot of moving parts. What's the key moving part that would drive us to 2.9% unemployment rate?
It would be a lack of workers, I think, more than the fact that people get jobs, because obviously that's implied by the unemployment rate. But if the participation rate continues to be about where it is, you're going to see the unemployment rate go down. And there are people who had forecast a 3% rate. Jim Bullard from the Fed thinks we could get to 3% by the end of the year. So It's certainly possible.
When you talk about the inability to hire workers, how do we gauge that, Mike, versus companies choosing not to hire simply because the cost is too high, given how much wages have increased?
Well, that's going to be an interesting tipping point, and something the Fed is going to have to worry about as it raises its interest rates. That'll tell us something about how the interest rates are impacting business spending. But right now, there doesn't seem to be a sign that companies are pulling back for that reason. They seem to be willing to raise prices to keep it up. Now, if Americans start to say no more, we're not going to pay these higher prices, then margins start to get impacted. Then we'll see maybe things slow down.
Mike, why do people trade on the ADP?
It's a question that everybody on Wall Street asks, and it's probably because there's nothing really else to trade on today. I mean, you can.
There are other things to trade on today.
You can trade on the Fed today, but the Fed doesn't meet every month on the ADP day. So most days there's not a lot else to trade on. It does give economists one more data point to fold into their forecasts, but people have learned you get burned pretty quickly with ADP sometimes.
Mike McKee, thank you, buddy. As always, traders going to trade.
Yeah, that's pretty much the answer.
Basically what he said.
Yeah.
Okay. Mike, thank you. This just came out from Slovakia, Tom. They're asking the EU for a three-year exemption to the import ban on Russian crude. I think it's important to go over this. That German dependency on Russian crude has gone from about a third last year down to 12%. So 12% of their crude imports are coming from Russia right now. So they've done a lot of work.
We haven't covered this today.
Slovakia's in the 90s, Tom.
Yeah, there it is. All I know is the Russian bond of 2042 is price up, yield down. It's still a train wreck, but the fact is price up, yield down. And John, dollar ruble is stunning. It is 66, down from that 80 level. And I'm sorry, it's strong ruble.
It's just some of the money that Slovakia's got to spend as they work through this, and who knows if they get that 3-year exemption. They're saying that they need to adjust the refinery for light crude oil, and that would cost a few €100 million. They're also saying they need 160 million euros of investments to adjust the pipelines for reverse flow from west to east. So, of course, none of this is simple. It's nuanced.
Yeah.
But there are different countries across Europe, as you know, to state the obvious. And I mentioned that 12% number for Germany. It's in the 90s for Slovakia. It's high as well for Hungary. So for other countries, it's going to be a much, much bigger thing for them to shoulder than compared to, say, the Germans.
I'll continue to watch that and the recent quiet, I should say, in the war news as well. Right now, with our chart of the day, Kriti Gupta. Kriti?
Well, as we talk about this FOMC decision, Tom, we have to talk about a trend, a almost decade-long trend that is nearly coming to an end, and that is negative yielding debt. You are seeing it go nearly extinct. Only 100 negative yielding bonds left in the world, mostly in Europe. And you can really see a steep drop. For our radio audience, take my word for it, a steep drop really starting year to date. It has everything to do with an extremely hawkish Federal Reserve. And like I said, a lot of that negative yielding debt still left in Europe right now. The question here is if you continue to see that policy divergence between the Fed, the ECB, the PBOC, and of course the other central banks around the world, how much longer does this go? The other bull case I should mention for stocks that could actually reverse this, or for bonds, excuse me, that could reverse this trend is the growth scare, the China scare, the ECB scare coming off the war in Ukraine. Will negative yielding debt actually go extinct as it was, say, about 8 years ago?
I guess, thank you. You know, Kriti, I get, John, I'm just looking at my bond portfolio.
You're distracted. Are you looking at that Century bond?
Yeah, I'm looking, at my Austrian bond. Well, you know, Irish Jersey told me to go into it.
Triple leverage.
Yeah, well, I'm down 50% on that Austrian piece.
Unleveraged, yeah.
You know, I mean, 5-0.
This is painful.
50%, 60% annualized.
I might actually start believing you that you did hold that. One thing that stands out for me, Kriti's talking about negative debt. Let's talk about the German 2-year. This is quite a move, guys, that we've gone to positive 28 basis points from negative 1 full percentage point back in the pandemic. That's a massive change. And the ECB has largely been left out of the conversation this morning. But think about what's happening at the moment. You've got Australia raising interest rates. You've got the whole world raising interest rates. India with a major move overnight, I think 50 basis points. The Fed set to go 50 basis points. That June meeting for this ECB, Lisa, is going to be huge.
It's going to be huge because they kind of can't just say they're going to stay the course. They can't say they're not going to raise rates. They have to give some signal. The euro is definitely depreciating to a point where it clearly will get their attention. And they're dealing with really what's going on in an economy that isn't just energy. Energy is the driving force, but the recent PMIs and the recent inflation data shows that it's elsewhere as well.
I say everyone's raising interest rates. That's not quite true because the Bank of Japan want nothing to do with this, Tom.
Yep, well, if I'm Christine Lagarde looking at her Bloomberg in Frankfurt this afternoon, her late afternoon into the evening, John, I'm going to focus not on euro yen, but on dollar yen, and to go out from a 118 level out to 130 now. That's weak yen, and that's those low interest rates. You know, we know the story, John, but maybe that's a litmus paper to follow starting at 1 p.m. this afternoon.
Dollar yen just about holding on to 130. Coming up, a conversation you do not want to miss. It's Paul Romer, the NYU professor and Nobel laureate, coming right up from New York. This is Bloomberg.
but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dinings, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Your day ahead looks a little something like this. 2 p.m. Eastern Time, you will get a Federal Reserve rate decision. Shortly thereafter, you will hear from the President of the United States. Yes, they scheduled that right before the chairman spoke at 2:30 Eastern. Looking forward to that a little bit later. Maybe they even clash. Your 10-year, 296.56, euro dollar 105.40. Positive there, 0.2%, and crude high, Tom, at 3.8%, 106.29.
John, thanks so much. As we had a 2-hour discussion last today with Kenneth Rogoff that we squeezed into a matter of minutes, we do that again with a laureate from New York University. Paul Romer joins us. He is a different economist in that from day one, the gentleman of Colorado has done academics at Rochester and beyond, where he has said, always consider technology. Paul Romer joins us this morning. Professor, thank you so much for joining. I want to go back to the heart of it, endogenous technological change. Do we actually understand what technology is doing to the American labor economy, to people in our many deciles?
Yep. So there's a good way to see if some of the problems we're experiencing in the U.S. are technology-based. Look at other countries. Same technology shocks are hitting all countries. And what's unfortunate is the U.S. really stands out as an outlier with this declining fraction of adult males, adult females who are working. All of the other countries, Britain, Germany, you know, they're seeing these steady increases. So it can't be technology which is explaining this decline in the U.S.
Jeffrey Sachs would agree with you. His book over 10 years ago now really got out front on this from a whole different angle, I would say. Professor Romer, Professor Sachs, two different views on a part of America that can't get a job. Why can't they?
Yeah, I think can't get a job is not quite right, because we've got all this evidence that there are jobs that are available. Right now, the returns to work, just the compensation you get, the quality of what the work is like, is just not high enough. We've let this deteriorate through a couple of decades now, and what we have to commit to is that everyone should be working, but if you work, you should earn enough to make it worth your trouble. So these increases we were seeing for jobs like a gas station attendant, 25% increase, that's catching up for declines that we tolerated for much too long. And we should be pushing for more increases in wages, more attractiveness of work, because we can't live in a society where people just check out, especially adults check out and don't work.
And Paul, you're saying this is the participation rate still hasn't gotten back to where it was pre-pandemic, still below that. Still, you're talking about the need for even faster wage increases at a time when people are very concerned about the highest levels of consumer price inflation going back to 1981. How much do you think that the flood of money put into the economy during the pandemic, the checks sent to individuals, actually undermined the ability to engage in fiscal stimulus like what you're talking about to get more people into the workforce?
Well, you have to think about targeting the fiscal stimulus. Like, what would be a targeted measure? We could have a subsidy for wages at the bottom end of the wage distribution. The government could pick up part of the cost, or we could be like other countries. We don't make the worker and the firm cover the full cost of the health insurance for the worker. So there's ways to target spending to make work more attractive that don't involve just like sending checks to everybody in the economy. And if you think about inflation, it's a weighted average of a bunch of price changes. So the wrong response right now is to say, we want to make those gas station attendants have lower wages or stop them from getting wage increases. There's a lot of other prices in the economy that we could be putting some pressure on without hammering the low wage workers who've been hammered for 2 decades.
There's the should and then there's the will. And as we talk, we know that President Biden is going to speak at 2 p.m. today to talk about deficit reduction to appeal to a lot of voters who are concerned about how much the debt limit and the debt has increased in this nation. What do you think will happen, given that the fiscal stimulus that you're talking about is unlikely, and given the pace of inflation and how it's being targeted right now?
Let me be honest. Especially in the realm of politics, I've been telling everybody for about 4 years now, add more variance to your estimates. Put more weight in the tails. We've seen more astonishing, unexpected things in the last 4 years than in the rest of my lifetime. So I'm not going to make any strong predictions about what's going to happen in the politics. All I can tell you is what I think should happen, and we should make work attractive for everybody.
Paul Romer, this is great. I love it how the Nobel laureate folks is telling us there's been 4 once-in-a-lifetime events in the last 4 years. Professor Romer, I want to go to the behavioral heart of the matter, and maybe this is very Jeff Sachs-like and others as well. Did all of this wage challenge and disincentive start with executive bonuses and the way that executives are compensated, and that well-meaning executives look at that if they give a wage growth to their lower 2 deciles, 3 deciles of staff, of labor, they're taking dollar for dollar from their bonus?
Yeah. To be honest, I think economists contributed to this because we argued, and I was one of them, these sounded right to me, that if we made the compensation for executives more variable, they'd have stronger incentives to do their jobs well. But more variable got translated into just higher payments almost across the board. And so we provided cover for this change in norms. And at the same time, we didn't pay enough attention to the really serious lagging effects we were seeing in the rest of the economy. And there were many beneficial effects from opening up to free trade, but we understood at the time that one of the harmful effects would be that people would lose jobs in manufacturing. And we always said, well, you can do something to help those workers, so everybody benefits from trade. But the problem is we didn't do that something, and so they suffered.
I mean, one of the things here, folks, that we need to say is Professor Romer is truly expert at monetary theory as well. You're having a cup of coffee today with the chairman of the Federal Reserve System, and he's looking at you saying, tell me about technology, tell me about labor, tell me about the dynamics of the American economy. Should he care about that, or does he need to stay riveted on a Fed mandate in the purity of what a central bank does?
I think I would tell him to stay focused on his mandate, which is really to watch inflation. And if you think about what was most damaging in the end of the 70s, it was the sense of living in a world where things were out of control. And what Volcker reestablished for us was that there was somebody who was in control and would bring inflation down. I think the job of the Fed right now is to show that they can bring inflation down, both technically and politically. They've got the room to do that, and they will. He needs to reassure people and give them confidence. But I think we really need to not let Congress and the executive branch off the hook on the rest of economic policy. It's their job to think hard about what do we do to make work and economic life attractive to everybody.
Paul, one of the biggest questions is whether the Fed's going to try to get back down to a 2.5% to 2% inflation rate in the near term, and that this will decide how quickly they have to go and the potential destruction to the economy. Do you think that they should target a higher rate of, say, 3% or more, the Adam Posen-like kind of idea?
I'm persuaded by that argument. And Olivier Blanchard was talking about 4% for a while. I think either of those numbers would be fine. The argument you hear about that against that is, well, if it's 3 or 4%, it'll also be 6 or 7 or 8 or 9, and that doesn't make any sense to me. We could target a stable 4% inflation rate if we wanted to, or a stable 2%. I think we'd be much better off at a stable 3%, maybe better off at a stable 4%.
Paul, you lived the Colorado boom. All I did was go down to the sink in Boulder and have beers. Coors 3.2's Light. Your Coors 3.2 Light, Paul, is your father's fault. I want to make that clear, just so we understand that. You live.
I'll take that.
You'll take that. You lived the Colorado boom. I can't say enough about that. There's a part of America, like in Ohio, with a primary we saw yesterday, screaming that they want their Colorado boom. How do we move the Colorado boom to Ohio without the Coors 3.2 beer?
Yeah. One thing that we aren't paying enough attention to is that the jobs can come to the workers, but the workers ought to be able to go to the jobs. Mobility has gone down, like cross-state mobility, partly because we've put restrictions on the supply of new housing. The housing's gotten so expensive in places that have these hot labor markets. So this is not something you can turn around in a quarter or a year, but we should be trying to increase the mobility of labor and also recognize a point I've been hammering on for a while, which is that the future is in cities. And we can't be talking about how do we bring life back, all this kind of manufacturing and other kinds of economic activity to small rural towns. It's not going to happen. You got to make room in cities for everybody who wants to move there to move there and get a job.
Paul, it's been fantastic listening to you. Thanks for giving us your time. Paul Romer there of NYU. Tom, what is Coors 3.2 like? What is that?
Coors 3.2 beer?
Yeah, what is that?
Oh, John, it's a fine beverage. One of the reasons I fell in love with English beer was it actually had body and
tastes like beer.
Flavor.
Something else.
I remember the first time I had Fisher, which was a French beer, and it was like, oh.
Something he just said there. 4% is good enough for them. 3% even. 4%, Bramo. Can you imagine if they signal they're okay with 4% inflation?
That if the Fed just brings down inflation to a stable 4%, perhaps that would be enough. It just sort of speaks to this idea that perhaps getting back to 2.5% in the near term shouldn't even be on the radar of the Fed, and they should just be looking for some sort of downward trajectory. It's sort of a radical idea after decades of the Fed talking about a 2% inflation target.
Bloomberg subscriber just writes in, Tom never ceases to amaze me with his knowledge of pubs. The sink in Boulder. TK, I'm not even going to ask the story that's behind that particular one. Coming up a little bit later on the Open, we'll catch up with Bob Michael at JP Morgan Investment Management. We'll speak to Erin Brown
You're not going to
of
let
PIMCO.
me, John,
we'll speak to Kate Moore,
Talagis, the
BlackRock.
music of Talagis.
A little bit later, Matt Lazzetti of Deutsche Bank, Danny Blanchflower
Talk through it.
of Dartmouth. Who else we got? Scott Minor at Guggenheim.
John, we're doing a remote, John, from the Rongovian Embassy.
Okay.
Ithaca, New York.
I want to see his Google searches.
I look forward to that. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Fed set to unleash its biggest interest rate hike in more than 2 decades. Policymakers are expected to wrap up their 2-day meeting today by agreeing on a 0.5 percentage point increase. They're also likely to announce plans to shrink the Fed's nearly $9 trillion balance sheet. Russia is focused on cementing both military and political control over the Ukrainian territory it has taken so far. The Kremlin is installing occupation governments and has ordered locals to use rubles for transactions. Bloomberg's learned there will also be referendums in some areas to open the way for full annexation. A study from the UK says that severe COVID may cause long-lasting cognitive impairment equivalent to losing about 10 IQ points. Patients were assessed 6 to 10 months after being hospitalized. They showed slower and less accurate responses than what was expected. The study says it was similar to how much brain power 70-year-olds typically have lost compared to age 50. Last month's arrest of billionaire investor Bill Huang for the collapse of Archegos Capital Management may just be the start. The U.S. investigations into questionable trading practices are on the rise. Those probes all center on the same question: are the markets rigged? Biden administration officials plan to pursue white-collar crime more aggressively. And CVS raised its outlook for the year and posted first quarter results that beat estimates. The drugstore chain's largest business, Pharmacy Benefits, reported revenue that was almost 9% higher than a year ago. Meanwhile, sales at the CVS health insurance business were up some 13%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I'm not a betting man. The odds are the following. Something like, yes, they can engineer a soft landing, a 1/3% chance, probably a 1/3.
Diamond with our friend St. Lacroix there talking macro today, really a larger picture of the American economy. And of course, the macro, we will stagger as we do to the Fed meeting this afternoon. I really love what Peter Bookvar said about it, Lisa. Historic but uneventful, maybe.
Maybe.
You know?
There could be some surprise
We'll
here.
have to see as well. I want to toss out right now, and we're doing this as we introduce Barbara Corcoran, who we like to talk to once a year, twice a year. She is a dynamo of the 5 boroughs and joins us today. But I don't want to make a joke about this. People magazine does an absolutely killer issue every year on women across all of entertainment, across all of enterprise and capitalism. And Barbara, they have selected you as a beautiful person. I mean, we were talking about Adele earlier in the show. I don't want you to sing like Adele, but I guess we can talk about your wheelhouse here, which is real estate, all the other things you've done over the years. Barbara, we've never seen rent and housing in this city, the disaster that it is today. How do we extricate ourselves from this train wreck of real estate pricing?
Well, it's not a total train wreck because it depends upon whose viewpoint you have. If you're a buyer right now, you're complaining that you can't possibly afford it. Interest rates have gone from, what, 2.5% to 5.3, I think, as of yesterday. And so everything's less affordable. So it's a train wreck from a buyer's view. But interesting, Tom, is the buyers are not slowing down. People are still grabbing real estate as though nothing is happening. And that's making a lot of people nervous. It doesn't make me nervous, honestly, because I see that the underfootings of the market are very solid. They're real users buying real homes that aren't highly leveraged and they aren't loaned out with crazy configurations.
If I look at Corcoran Group, that you built from scratch, if I look at it on, say, Tony Madison Avenue or down in the fancy downtown area, the number one fear is we don't want to make New York City look like a given East German city. We don't want row after row of ugly high rises. How do we create more housing that Mayor Adams wants without looking like a given city in Eastern Europe?
Well, the reality is they're not going to be putting affordable housing right next door to $15 million condos. It's just not going to happen. So whether you like the concept that there are some poor neighborhoods and some very, very rich neighborhoods, that die has been cast in New York a long, long time ago. There was never a time when Midtown Manhattan was inexpensive, nor will there ever be, I hope. But the problem really is in the city's court for making affordable housing. Our supply is like 1/3 of what we actually need. And I think those public work programs are going to happen. And I don't think they're going to happen in the part of town that people want to impress their friends with. It's just not going to be.
Barbara, you're talking about how the footings of this market are incredibly solid, that people are not leveraging their purchases. Are you saying that the housing market of 2022 is more immune to the rising interest rates that a lot of people are hoping will dampen some of the price increases that we've seen on homes?
I'm not saying it's totally immune, but it's better equipped to handle it simply because you don't have leverage buying. In the Sun Belt right now, about 1 in 8 homes are being purchased by investors. That worries me. You didn't see that 2 years ago. So that makes a buyer that I'm not as confident in as a regular buyer who's going to raise their kids in that house. But the people who are buying homes today are not highly leveraged, and there are no bank programs that make them or tempt them to be leveraged out. And so that gives me a great great peace of mind. Of course, interest rates is his partner in the housing market. If those continue to shoot up, the government will put down the housing market, and with it, the inflation and all the problems will follow the housing market. It's a leader in the inflation category. So that if that changes, if people are irresponsible in the government in that regard, of course we could demolish this housing market, but nobody's really expecting them to act that way. I hope you share my confidence.
What would you be investing in right now, Barbara, if you had $1 million, $2 million?
Well, what I'm investing in secondary cities. It used to be that the primary cities like New York City, Chicago was the best place for investments in real estate. And of course, I love that because it's a slow way to get very rich. But what I'm doing right now is I'm investing in minor cities, or secondary cities, I should call them, or they'll be offended, like Baltimore and many of its small cities in the Midwest, because the inflation rates are greatest there in real estate values.
Barbara, like Chicago or Los Angeles or Miami, right? As a secondary city.
Yes, thank you very much for giving me my words.
Barbara.
I was groping there.
Yeah, Barbara, a simple question which so many people want to know. If house prices go up 40%, should people's property taxes go up 40%?
No, I just don't think so. It would break the back of the housing market.
Yeah.
You can't have that. People can't take it on both sides. No.
Okay, Barbara Corcoran, thank you so much for joining today. The Corcoran Group, and featured in People's Magazine. Okay. Really good to see that as well. And you know her from Shark Tank, I should say. Lisa, we have a busy day. I mean, the surveillance nap, I think, is out the window.
Yeah, I think unless you're going to nap through the Fed meeting, which I think Peter Bukvar.
I'm not going to nap through the press conference. Now, don't tell secrets.
Maybe, I don't know, Peter Bukvar is saying it's not going to be
What happens on surveillance stays on surveillance.
Yeah, I'm sure no one else can see it. I do want to say there was one thing we didn't mention today, that this came out a couple of minutes ago, that the Treasury actually reduced the amount of borrowing that it expects to do over the next quarter. This matters.
So what?
Yes, this is why so what? Because at a time when people are so worried about the Fed buying less of the debt that is issued by the United States, the U.S. is selling less debt, and they cut those debt sales that they're planning even more than people expected. In other words, if you're looking at this supply-demand dynamic, right now you actually see that it's not as out of whack as it might have seemed given how much the Fed expects to reduce their balance sheet. In other words, could this be supportive for yields? Dead silence. He's already taking his nap.
When's the next auction?
Well, it's coming up. They just had a slew of auctions. I will get the dates for you exactly. I don't have it off the top of my head.
Bated breath.
I know. You're already asleep.
This afternoon, folks, we have really put together a fabulous team. Our team has just hit the ball out of the park, over the turnpike, over the Caskin flag, and Red Sox beating Angels last night. Thank you. First win since, the first win in May, I should point out. But seriously, a great list. Lisa, Matt Luzetti joining to start us off, I think is a big deal.
Yeah, I think so, because they've had a pretty contrarian call, and they've been pretty aggressive in terms of how fast they think the Fed should go. Just want to note this. 2-year yields have taken another leg higher throughout the morning session, and I think this is telling. They're at session highs of 2.82%, the highest levels going back to 2018. Is this fully pricing how hawkish the Fed will be? How will they respond to a 75 basis point rate hike in June?
Right.
And will they go a little bit harder on the quantitative tightening side?
210 shows that the 2-year yield up more than the 10-year yield is up. It comes in 4 basis points on the 210 for those keeping score at home. We have an eventful morning. Please stay with us on radio and television as we move through the morning. And again, not at 2 p.m. We will begin on this historic day with Chairman Powell and the Fed. We begin at 1 p.m. Please stay with us. Futures up 10. Dow futures. We didn't mention Dow futures the entire show. That was remiss.
Catastrophe.
Dow futures up 70 points. This is Bloomberg.
Rising energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City this morning, good morning, good morning. For our audience worldwide, a big day coming up. Equity futures positive 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, counting down to Chairman Powell.
Chair Powell, Chairman Powell's press conference. It's 2:30 when Chair Powell will lay out both the path and the trajectory.
The market's been teed up to be very hawkish.
200 basis points of rate hikes over the next 4 meetings.
How hawkish are they going to be?
It's a foregone conclusion the Fed goes 50 basis points.
What are the odds of 75?
The key priority for them is to get their policy rate up to neutral.
They'll leave all of the hawkish options on the table.
He's going to be very clear that he's going to be able, he will go as fast as he needs to.
They'll, ramp up the balance sheet reduction.
They've signposted it pretty clearly that they'll end up starting either in May or June.
They'll signal more hawkishness and more rate hikes ahead.
As far as where the surprise could be,
the potential for surprise really is in the press conference.
Let's get to the panel. Joining us now to discuss is PIMCO's Erin Brown, Bob Michael of JP Morgan with us too. Erin, first to you, your expectations for that news conference, that decision a little bit later.
I do think it's baked into the cake that the Fed will hike 50 basis points at this meeting. The real question comes to the guidance around future rate hikes. The market right now, as earlier noted, is pricing in 200 basis points over the next 4 meetings and then slowing to a 25 basis point clip thereafter. I think the question is going to be how forceful they are around that guidance, how clear they are around that guidance. Without a release of a summary of economic projections today, it's really going to come down to commentary around how they guide for the rest of the summer and then into the rest of the year. Our expectations is that, they'll certainly move to above pre-pandemic levels by the end of the summer. But, there could be bumps along the way, and there's a lot of uncertainty that still clouds the outlook. So the question really comes down to whether they continue to be, allow some wiggle room around that guidance, or whether they really, sort of take advantage of market pricing today and, be very clear about what their likely outcome is to be. The other thing to look out is certainly certainly how they guide towards the balance sheet.
Bob, just how high is the bar today, and how difficult will it be for Chairman Powell to out-hawk this market?
I think the bar is pretty high. I mean, I have 3 asks of the Fed. We think they're going to do 50 basis points. I actually want to know how many dissenters there are at 75 basis points and what he says about 75 basis points at the press conference. We think they're going to announce quantitative tightening starting with June and some sort of ramp up. I want to know, why not now? Why the ramp up? You're miles behind. Just start today at 95 billion caps. And then lastly, he's probably going to say everything's on the table. Well, great. What's the trigger for activating some of everything that's on the table? So I think he'll meet market expectations and leave a lot of unanswered questions.
Nomura shares that view on 75. They actually think we'll get 75, though. This is what Nomura have got to say. They look for 50 today, followed by rate hikes of 75 basis points of both June and July, before a more gradual pace of 25 basis point hikes, ultimately getting to 4% by mid-2023. Erin, many people think that question gets asked in the news conference later of Chairman Powell. 75 basis points, yes or no in the coming meetings. How do you expect him to answer that question? And what detail are you looking for?
I think he will leave the door open, but I don't think he's going to completely shut the door on 75 basis points. But remember, just a couple of months ago, it was pretty unheard of for the Fed to hike 50 basis points. They haven't done it since 2000. So it's been, 2 decades now since the Fed has made such a significant move with respect to, its policy, hikes. And so, while certainly that remains open as an option, I don't think it's the base case right now of the Fed. And I think there's going to be a lot of ambiguity where the Fed will certainly caveat that it remains a tool in its toolkit. But I don't think right now with the Fed, sort of expectations, not pricing in 75 basis points a meeting, I don't think that the Fed is going to front run that with hawkishness today.
The decision, 2 p.m. Eastern time, then the news conference, 2:30, and in between, apparently, we hear from the President of the United States as well. I'll catch up with AMH down in Washington a little bit later on that. Mike McKee, a busy couple of hours ahead of us.
Absolutely, and the question, as you've discussed it, is exactly right. How hawkish can the Fed be today? I think Bob Michael hit the nail on the head with the 75 basis point question, because if you take a look at the WIRP function on the Bloomberg and how many rate increases are priced in by the end of the year, you can see that right now we're at 32 basis points for an effective rate, and after today's move we go to 85, but then by the end of the year we're well over 3, and that has been moving up all morning. So to get that far by the end of the year, they're going to have to move more aggressively, and the way inflation is moving, they're going to have to do that to keep inflation in check. So today we're watching for the first 50 basis point move of the Fed since 2000, or maybe do they surprise? The statement is going to have to change. They will probably say ongoing increases to the target rate will be appropriate as we try to set the market expectations for the future. And then it is all about how does Powell dodge that 75 basis point question? He's not going to promise anything, but he doesn't want to rule it out either, I would imagine. And then we get the balance sheet reduction details and the impact on rates. Now, the interesting question coming out of this meeting when they raise 50 basis points is if they do get to that 3% mark by the end of the year, what's that going to do to real rates? Well, it's only going to give you an effective Fed funds rate of about -2% because we're so deeply negative with inflation where it is now. You can see that's the change in the yield curve since the last Fed meeting, and the short end is still way negative in terms of its inflation rate adjusted the Treasury. So a long way for the Fed to go, and exactly where do they stop?
Mike, what do you make of the president scheduling a speech in between the decision and the news conference? What do you make of that?
It's hard to know. Obviously, he's looking for as whatever kind of good news he can. The problem for the president is that he's never on time, and Jay Powell is. So if the news conference starts at 2:30, the president's going to have to get there quickly enough.
The only thing I can promise, I'll remain committed to this. We will take Chairman Powell for you at 2:30 Eastern Time. Mike McKee, thank you, buddy, as always. A lift at the front end, yields up by 3 or 4 basis points, 282. That is the high of the year on a 2-year yield. Bob Michael, I was really looking forward to asking you this question. Have you got the clients lined up to say, let's put some money to work back into this bond market? What are they saying, and what are you telling them?
We do. For the first time in actually quite a bit of time in some channels, particularly the large plan sponsors, the pension funds and the insurance companies, they're looking at the backup in yields. They're looking at the backup in credit spreads. They can buy 30-year credit at 5%. There's an opportunity to de-risk. So those are the first conversations we're having of that type in a couple of years in earnest. We look at the retail market. I met with a lot of retail clients yesterday. They're sitting on a lot of cash. They did some de-risking. They're looking at the municipal bond market. At the end of last year, state GOs were about 1%. Now they're about 3% in yield. So there's a lot of opportunity there. And yeah, look, you have to appreciate there's been a tremendous repricing in yields and credit spreads and Fed expectations. And it's going to take a year, we think, for the Fed to meet those expectations, and the market will do well in that environment.
Well, just to separate a couple of things, help me understand this. Are they looking to play defense in the bond market a little bit more, or offense in the bond market a little bit more?
Well, they're looking to put capital to work for the first time in recent memory where they feel there's an alternative to equities, that they can actually buy the high yield market at above 7%. So they're at the top of the capital structure. They don't have to own the bottom of the capital structure to try to generate return. They're doing both. They're looking at, I said, de-risking because they've established these glide paths to meet their long-term liabilities. They've had a repricing. Why not take advantage of all the time you spent on that glide path and put some money to work? We're seeing both ends of the spectrum.
Erin Brown, does this resonate with you?
Very similar conversations that we're having as well. And, you keep in mind, I think a lot of it is a defensive move, just given the sort of level change that we've seen in yields. But I also think that this is part of the long-term, sort of capital market assumption glide path planning for, plan sponsors or for, even individuals, that they have been over allocated to equities because that was the only place that they could really pick up incremental return. And now there's an alternative to that. And so that they are starting to shift their allocations. The one comment we have heard has been that, some investors are waiting for bond volatility to subside. So if you look at the MOVE index on Bloomberg, that's one of the things that people are keeping an eye on, that once they start to see bond volatility subside, that will be the real trigger for them to start getting, more meaningfully involved in the fixed income market. But these yields are starting to look much more attractive, and we're having active discussions with our clients around it.
Erin Brown, Bob Michael sticking with us going into the opening bell. We need to dig into this a little bit more. Before we get there, a ton of movers to talk about. Let's get to Taylor Riggs for more. Hey, Taylor.
Yeah, John here. Sorry, I almost called you Romaine. I'm so used to being on in the afternoons. John, take a look here at some of the earlier winners, of course, that we're looking at. CVS, of course, is one of those. Now, comp sales came in a little bit better than expected. And then, of course, we think about that forward guidance, actually raising that just a little bit, and something that we haven't really seen a lot, perhaps, in this quarterly earnings season. I want to point to Moderna as well. They're up 6%. Vaccine sales were better than expected, but similar comments that we heard from Pfizer yesterday, not increasing them a whole lot on a go-forward basis, given a lot of people are expecting COVID perhaps to move behind us when you think about some of the COVID treatments and the vaccines. John, we have to talk about Lyft. I think what was so interesting is yesterday after the bell, the numbers looked okay, and then you got on the conference call and you got a lot of that negative forward guidance. You got a lot of misses on the bottom line. You have a lot of commentary coming out about sort of the driver shortages and then the driver incentives. And those incentives, I think a lot of analysts thought were behind us. And that clearly is not the case, as a lot of those incentives are still very much going to be in the picture. And I think a lot of that, John, according to analysts, or why Uber was supposed to report after the bell today, they moved that up this morning. The numbers looked a little bit better, but it's sort of getting lost in the shuffle as people really think about the reopening and, of course, these big incentives that these companies are still having to look at.
Thank you, Lisa. I'm joking. I'm joking,
Sorry.
Taylor. I'm very happy to have you in the seat. You know that. Looking forward to your coverage through the opening bell. Taylor Riggs there with us for the next couple of days. Coming up, the EU planning to ban Russian crude.
So today we will propose to ban all Russian oil from Europe. This will be a complete import ban on all Russian oil, seaborne and pipeline, crude and refined.
That conversation up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We will make sure that we phase out Russian oil in an orderly fashion. So in a way that allows us and our partners to secure alternative supply routes and at the same time be very careful that we minimize the impact on the global market. And this is why we will phase out Russian supply of crude oil within 6 months and refined products by the end of the year.
The EU planning to ban Russian crude. The proposal, however, running into threats and objections from both at home and abroad. Hungary continuing to push back. Slovakia preparing to demand an exemption. The Kremlin responding, saying the EU will pay a bigger price each day. Joining us now from Germany, Maria Stadeo and Anne-Marie down in DC. Maria, walk us through the plan, please, piece by piece.
Well, look, let's take a look at the big numbers here. First of all, we now have official confirmation from the European Union that this new package will include oil. Remember, Jonathan, the choreography, and we've tracked this repeatedly on the show, was first we do coal, that's done. Then we move to oil, that's exactly where we are right now, and then potentially into gas in the future. But it's not going to be easy. When you look at oil, what the European Commission is putting on the table is a transition period from now until the end of the year to do this slowly. That would give some countries, like the country I'm in, Germany, to adjust for it and prep their industries for this cutoff. It's also interesting that it's not just the oil, but it's the world around it. So this is the transportation of it, the insurance, the cargo ships, the vessels, all of this would also be banned alongside the commodities. But Jonathan, I should note and point this that a lot of this was already happening. When you look at the energy imports from Russian oil to a country like Germany, they had declined from 35% to now 12%. A lot of the private companies that deal with this did not want to touch Russian oil because they feared those sanctions. So in many ways, this is just catching up with reality. But as you say, this is already running into obstacles. The Hungarians are saying that they see this as very problematic, that this would have a big implication for their economy and are prepared to veto it. So again, the question is whether or not the European Union will put forward an exemption that they find doable enough. At this point, there's a lot of tension between Viktor Orban, the Prime Minister of Hungary, and the rest of the European Union. And then you have the Russians saying, okay, go ahead, do it, but there will be retaliation. And by the way, it's a European consumer that is going to pay this on a daily basis. But I would also note, just a little cautious there, Jonathan, the Russians stand to lose billions if this goes ahead. And of course, we have seen that this invasion of Ukraine is now very long, it's very sticky, more than 70 days, and this costs a fortune for the Russians, and they have not been able to secure major victories yet. So for the Russians, it's also complicated.
MH, just quickly, we'll catch up with you again later in the hour, but the president's going to be speaking a little bit later. We've heard from him already in the last 24 hours. What are we expecting from him?
Well, the last 24 hours, what he spoke about really was about Ukraine, and he was at a Lockheed Martin factory where they made these Javelin missiles, which really have been incredibly not just useful, but really a turning point for the Ukrainians as they're trying to stem off the Russian assault. Today, it's all going to be about economics. He's going to talk about deficit reduction and then parlay that into the fact that what more can be done to make it a more productive economy, things like prescription drugs and all these items he talks about in his Build Back Better plan.
AMH, we'll catch up with you in about 20 minutes' time, and we'll see if we actually hear from the president between the decision from the Fed and the news conference from the Fed a little bit later. Thank you. Aaron Brown, Bob Michael, back with us. Bob, given what Anne-Marie just talked about there, fiscal discipline returning, you've talked about the bond buyers, they're back. You're comfortable saying we might have seen the worst of it, the long end of this Treasury market?
I think for now, and I think what's important is for the first time in a long time, the market looks fairly priced to us. And you know, the surprise to me isn't that the 10 years at 3% today. The surprise was it was 1.5% at year end. And with the Fed fund forward curve out around 3%, 10, 12 months out, that's a long journey for the Fed to get there. Let's see what happens along the way. Let's get a couple 50 basis point rate hikes under our belt, some months of running down the balance sheet under our belt, and then see what the impact of those plus inflationary pressures are on the consumer and on the economy. Right now, we don't know, but it feels like 3% covers us for the time being.
Andrew Sheets of Morgan Stanley said something similar. He said this: what's already in the price matters. I can see a scenario where the Fed is being hawkish and is still hiking, but longer dated bond yields don't rise very much. Erin, can you speak to that? The relationship between what the Fed may or may not do in the coming weeks, months, quarters, years perhaps, with the longer end of the yield curve?
Yeah, I think that's right. I mean, I think that even in the front end, you've seen a lot of market pricing now priced into the front end of the curve, and that certainly trickles into the back end of the curve. And, you know, for us to have a meaningfully move higher in terms of yields from here, either the market expectations for the Fed have to move much more, hawkish, and that would affect the front end, or the market has to meaningfully increase its expectations for long-run growth and inflation, which would hit the back end of the curve. And I think that given what's priced in the market today, I think that, and given, for the back end, our expectations for productivity growth and for, real growth in the longer dated part of the curve, I think that the market is fairly priced today. Now, could we see a little bit of continual sell-off of the back end? Certainly as the Fed continues to hike into, this environment, yes. But I think that the velocity of the move is certainly behind us. And I think that going forward from here, it's going to be much more balanced in terms of the volatility that we're seeing. And that's what I think is giving, some market participants comfort here, that there is value now in that back end of the curve. And we haven't seen this type of pricing in quite a long time.
Bob, just quickly, a man called Jamie a little bit earlier this morning said, deep breath and give the Fed a chance. Let's take a deep breath and give the Fed a chance. I'm trying to work out what these interest rate hikes will mean for this economy. When I get guest after guest on this show say things like household balance sheets are really strong, corporations are resilient, they're well funded, banks are in good shape. If that's the case, how sensitive will demand be to incremental increases in the interest rate from this Federal Reserve? Do they have to go more than perhaps some people expect?
That's a really good question, Jonathan, because I worry about the next 4 to 5 months for the Fed. I'm in the camp that they're going to do 4 50 basis point rate hikes over the next 4 meetings, because I think over the summer, we're going to see the worst of the inflation data, and we're going to see this reopening burst in pent-up demand everywhere. You're already seeing it in travel and leisure if you've gone through an airport. And all of that's going to happen at once. At the September meeting, they're still going to be looking at very strong data. So I think you got to put 50 on the boards for September. We didn't get to the what question should Mike ask in his customary
Well,
last
you could do it
position.
now, Bob. Take it.
What he should be asking is, what kind of conversation did they have about intermeeting rate hikes? Was that on the table? That's what I want to know. I think that is on the table.
I'll give you that, and you can have this too. I know you're a happy man today. You look happy. I know you're happy with last night. You're going to be happy this weekend. Will you be happy at the end of the season, Bob Michael, as a Liverpool fan?
Hey, the must-watch for me is 3 o'clock. I want to know who our opponent is. And while I'm tired of going head-to-head with City, do I really want to face a team that's actually better than them?
What do you think? Who would you rather play?
City.
City, every time. Bob Michael, thank you, sir. I'll be watching the Fed show a little bit later because I'll be in the Fed show a little bit later, and I'll be missing kickoff of Liverpool Real Madrid. Bob Michael, Aaron Brown. Bob, I hope you're on the trading floor later and not watching that game.
Madrid.
Come on,
No, it's
City
City.
Real. Yes, yes, yes. City Real. I'll get my games right. Bob, forgive me. You should be my copy editor too. Coming up, the morning calls and later, markets grappling with slowing growth and surging inflation. BlackRock's Kate Moore remaining cautiously optimistic on the outlook for stocks.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Five minutes away from the opening bell, equities up about 1/3% on the S&P. That's the price action. Here are your morning calls. Morgan Stanley downgrading Carvana to equal weight and cutting its price target by 70% to 105 a share, highlighting serious challenges to continue growing its business. Evercore upgrading Starbucks to outperform $95 price target, forecasting some stabilization in China trends by the fall. And finally, Susquehanna downgrading Lyft to neutral. $25 price target, expecting macro headwinds to continue weighing on shares in the near term. I think this is the second time this week we've talked about horses and barns and bolted and all that stuff, down 27% on Lyft. I can confirm the president has moved that speech from 2 p.m. when the Fed was deciding to 11 a.m. Eastern time. That one makes maybe a little bit more sense. Your opening bout up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
24 seconds away from the opening bout. Bob Michael still having a go at me for messing up my football games. I apologise, Bob. Futures are positive 0.2% on the S&P. On the Nasdaq, up around 0.4% on the Russell. On the Nasdaq, up a little more than 0.1%. That's the price action in the equity market. There's your opening bout. Switch out the board and get to the bond market. Yields look a little something like this. Up a basis point on a 10-year to 298. After having a little look at 3% earlier on this week. In the FX market, a euro showing just a bit of strength. 105. It's been tough to break. We've been holding on to it. Had a little look at 104 a couple of times over the last week, but didn't like life down there and have got back up to 105 okay. That's where we're hanging out on euro dollar. Crude, 106.99, let's call it 107 now, up by 4.5% as the Europeans come up with a plan to ban Russian crude. That's the breakdown of things cross-asset. Let's talk about Lyft and Uber and get over to the West Coast and catch up with Ed Ludlow. Morning, Ed.
Morning, John. Just a monster amount of earnings to get through. Going to start actually with Advanced Micro Devices, AMD. Shares were pushing higher. Analysts really positive about demand for data centers when it comes to the chip sector, right? But there's a little concern about laptop, PC demand. So you see analysts cutting price targets, even though the stock's up almost 7%. Of course, AMD, one of the worst performers on the Philadelphia Semiconductor Index this year. Airbnb, very similar story. Bullish outlook on demand this summer. Restrictions lifting in North America, helping travelers get out there, book vacations, and Airbnb reporting strong numbers. And then let's get to the story. Lyft now down 28%, John. Monster move, biggest in its publicly traded history, losing a big chunk of its market cap. Basically, a tepid forecast for EBITDA because they have to invest in driver incentives. Now, some analysts are saying this sell-off is overdone. You look at Uber also getting caught up in this general story around the long-term profitability of these businesses. But in the sense that it's overdone, they're saying, well, if Lyft is committing to spending on driver incentives, and even though they had softer than expected ridership in that quarter, it actually shows that Lyft has bullish outlook of their own because they want to spend on driver incentives to meet demand that might not be visible right now. That chart, of course, showing both stocks since their IPOs pre-pandemic back in 2019. And it's not been a great story, John.
Ed, I know how hard these guys work driving these cars. You do too. Right. They work really, really hard to not make much money. Gas prices are up. They've got to pay for their car. Isn't this just the end of the era of cheap labor for these companies?
Yeah, look, I mean, Dara Khosrowshahi, the Uber CEO, kind of lingered on this point that actually driver availability was really up in the month of April. And what they're seeing is that they have a diversified business, right, where you can be an Uber driver, but you don't just drive people. You can do Uber Eats, you can do Uber Freight. And so in that sense, they're able to offer more to the drivers themselves. And that seems to have given them a competitive advantage over Lyft, which has the pure play riding.
Lyft is getting battered. It's down 29% in early trading. Ed, great to catch up. Thanks for waking up early on the West Coast to bring us some bad news about Lyft. And Uber, as Ed pointed out in the last 24 hours repeatedly, was due to report results after the bell, saw what happened with Lyft, brought them forward to before the bell. They had some good news to tell. They thought they did anyway, perhaps. We're down by a lot there on Uber as well. Elsewhere, investors gearing up for Chairman Powell. Strategists growing increasingly concerned about the combination of slowing growth and high inflation.
We have slowing growth and inflation picking up, so some people think stagflation's a real risk. And we know that we have the removal of the central bank put. Returns are going to be a lot lower, and we're going to have to work really hard for our clients to find those opportunities.
That was Goldman's Katie Koch, and she's not alone. Taylor Riggs back with us. Hey, Taylor.
Yeah, John, I think sort of the story that we've been talking about pretty much all year, and I know that you've been focusing a lot on it in the last few weeks of the program, is the defensiveness of this rally that's underway. And you see that with some of the staples. We're going to take out energy for all intents and purposes because that's a different story. Other than that, the staples have been the big sort of outperformers in this market, right? As you think about the defensiveness that has been the staples, the utilities, and really sort of the big outperformers relative to big tech and some of the classic more risk-on sectors. What's, I think, sort of been underlying this tone as you think about sort of the rising rates, sort of the sell-off in those long duration assets, and then, of course, the weighting on the S&P 500, the market cap index. Romaine would get so angry at me by looking at the equal weight index, but the equal weight index here has actually been sort of the underperformer. Typically, though, that hasn't been the case. Like this year, you're thinking a lot about sort of the equal weights and the big outperformance, given the sell-off in big tech and the big weighting that has had on that market-weighted index. So that sort of equal-weighted index is one that we've been watching on big days when you think about big tech getting hit the hardest. We've talked a lot about TINA and FOMO, John, and I'm not sure that maybe 3% on a 10-year is enough to get you excited. But if you think about a dividend yield versus a treasury bond yield and where there are some other alternatives out there, you could argue that perhaps maybe some of the yield advantage here on equities is declining a little bit, in part because you're getting a big sort of reflationary lift on bond yields. And what is that number when bond yields actually now start to compete with some of the equity alternatives out there?
Why does he not like the equal weight?
The same reason you don't like the Dow.
I know, but the Dow is so much worse. The Dow is so much worse than an equal-weighted S&P. At least it has the title on the equal-weighted S&P. It is what it is. It does exactly what it says it does.
Don't tell him. Don't tell him I mentioned it.
I'll message him later and find out what the big deal is. Taylor, thank you. BlackRock's Kate Moore joins us now. Kate, last time we spoke, you weren't as defensive as you are now. What's changed?
So I would say, Don, it's not that we're overly defensive. It's that, while some people have said, okay, we've created a tremendous amount of value in the market at this point, and perhaps it's now a time to step in, I think we're more in wait-and-see mode. We de-risked in our portfolio earlier this year. We're sitting on very high levels of cash relative to history. And as much as I want to jump in when I see some of these companies derate as much as they have, and I think we're getting closer to peak hawkishness when it comes to the Fed, I'm still remaining a little bit cautious about adding a lot of incremental risk in the near term. I'm struggling, I think, like a lot of investors, to come up with powerful catalysts aside from some technical and sort of sentiment pops to lead to a more sustained rally in the equity market.
Okay, let's talk about how to play defense then, because the defensive part of this equity market, there was a real bias there over the last few months, and then even the defensive names got caught up in some of this as well. So help us understand how best to play defense in a world that we're in at the moment.
Yeah, John, I think there's been a bit of lazy investing happening over recent months. In particular, people are looking at a defensive playbook, like perhaps to say, they want to invest in staples or utilities, as Taylor was just discussing. But those are not necessarily companies, I think, that are going to be able to meaningfully maintain their margins or even grow earnings through a slower economic growth cycle. And so we actually think defensive means looking at quality companies who have a little bit more of a kind of a Teflon earnings stream. Believe it or not, for a lot of that is in technology. There's some parts of consumer where brands or services are unlikely to be you're not going to see diminished demand for them, even if economic growth slows and the Fed really manages to slow down the overall economy. So I think it's more than just looking at sectors. It's looking at companies. It's looking at business models. And it's looking about really where the future of demand is, not just what kind of the playbook we've had in the past of defensive sectors or industries.
Okay, let's talk about where that demand is, where it has been and how it's changing. As an economist, you might be looking at the rotation of consumer spending away from goods and towards services. Is that an equity story for you too?
Yeah, it is a story. I mean, I think a lot of that has started to play out already in price action, by the way. We've known that this transition from goods to services was going to happen as soon as the U.S. and global economy opened up in more meaningful size. But even within services, I mean, some of those services have meaningful pricing power. Some of them have pricing power that's enduring, as in not just a snapback to activities that people had to pull back on during the pandemic and when there were shutdowns. And so, again, this is going to be more like company by company and sometimes industry exposure, as opposed to just saying, I'm rotating wholesale into services. A moment ago, you played that clip from Katie Koch at Goldman Sachs, and I think that's completely spot on. This is going to be a more challenging aggregate returns environment, and you have to be more agile, and you have to get deeper into specific stories. You're seeing this really play out as companies have reported earnings over the course of the last few weeks. It's not just good enough to have had okay results or solid results that maybe beat consensus expectations for the first quarter, but companies have to offer up guidance and give a level of assurance to investors that they have earnings power in coming quarters.
How many companies are actually able to offer guidance at the moment, Kate?
Oh gosh, yeah, that you have to catch me on that one. You're right, because fewer and fewer companies are offering up guidance than they have historically. One bit of data I was looking at earlier this morning was actually the number of companies that have reduced guidance relative to raised guidance or maintained their previous guidance. That's come down, but we're talking about a pretty small pool relative to history. Look, if you're a corporate management team, there's not a huge amount of incentive to put big, far-reaching numbers out there. The penalty for missing is pretty significant. So it's not so much just about the earnings numbers, but it's about sort of the direction of travel for their businesses that we're paying attention to.
Missing the rally on crude, there's been a big penalty for that. Energy names on the S&P up 44%. And just going through your notes, Kate, some of the calls from you and the team, this is a part of the market that you still like, the energy patch. Why is that?
Yeah, I mean, we liked energy before Russia's invasion of the Ukraine, by the way, and a lot of that had to do with a supply discipline, frankly, in the sector. And, that CapEx and supply and spending discipline we think is going to persist, even if on the margin we see a little bit more production out of other parts of the world, given the situation with Russia. That said, it's possible in some parts of the commodity complex, even though we remain really constructive, we see a slightly weaker demand environment over the course of the next few months than we saw over the past couple months. I think that will be an opportunity to add in more commodity and resource exposure for the medium term. So we're looking at any weakness, like we've seen a little bit in copper and some other base materials, as an opportunity to add for a more medium-term view.
So, Kate, am I doing that in the US or through the European names?
These are global names, right? Commodities are a global market. So some of the U.S. materials names have a little bit more sort of chemical bias to them. The global miners are listed, more often in London and in Europe than the rest of the world. And then there are really specific names, actually interesting names in parts of the emerging world, I think, that can add to your resource basket.
Are you comfortable with the beta to Chinese growth associated with some of those names?
Yeah, some of those names have had, as you point out, incredible beta to Chinese growth historically. That said, we think there's broad-based demand, both from construction and overall industrial activity, that will support, combined with relatively lower inventories than we've seen in history, and combined with not just the supply discipline we saw in the energy sector, but across a lot of the miners. So, look, it's a pretty good story. If China completely collapses, of course, we're going to see a massive sentiment hit to a lot of these names. Yeah. That is not our base case at this point, and certainly does not work in Xi's favor going into the fall party meetings.
Kate, I think we just had an 8-minute conversation without talking about the Fed, really, which was quite nice. Thank you.
It was a beautiful moment.
Wasn't that? That was special for you and I. You can frame that. Kate Moore of BlackRock. Kate, thank you. as always. 12 minutes into the session, equities up by almost 1/10 on the S&P, on the Nasdaq down about 1/10. Coming up, President Biden looking to insulate the U.S. economy from issues abroad.
The events of the past few years have proven beyond a doubt that America's security should never be held hostage to events overseas. Not a pandemic, not a war, not the politics of ambition or other countries.
We've joked about this all morning. The president was due to speak at 2 p.m. Eastern Time, shortly after a Federal Reserve decision. Tom Keene called it clumsy. Anne-Marie said it was curious, and the White House must have been listening because that's been moved to 11 Eastern Time. That conversation up next.
Happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We're going to ensure the semiconductors, the power of the economy, and our national security are made here in America again. And it should create and support entire families and expand U.S. manufacturing and strengthen our national security.
President Biden delivering remarks on the U.S. economy at 11 a.m. Eastern Time. The GOP's Kevin Brady criticizing the administration in a statement, writing, quote, accelerating inflation, a worker crisis, and the growing risk of a significant recession are the signature economic failures of the Biden administration and will likely get worse. AMH down in D.C. Anne-Marie, a time change from the last time we spoke 20 minutes ago. What's behind that?
Well, we don't know officially, Jonathan, but it's obviously an apparent move of what the president was up against, which was a massive decision from the Federal Reserve today. And then, of course, remarks in a news conference by his own Fed chair. Now, President Biden always wants to make sure that he stays far away from the Fed. So if this looked like there was any trace of interfering with the Federal Reserve, it does look like that is possibly why they have decided to move this speech now to 11 a.m. I called it curious before, and now it looks like it's obvious, connecting these dots, why they've decided to move up that speech.
AMH, let's talk about substance. What are you expected to hear from the president later this morning?
So he's going to talk about the deficit and how the deficit is coming down and there's less economic spending, but also from a government official, Jonathan, take a listen to what they are saying in terms of what we can expect. The president today will speak to this important news and his commitment to reducing the deficit going forward while making critical investments to boost the capacity of our economy and lower costs for American families. Essentials like prescription drugs, healthcare, and utility bills. Josh Wingrove, my colleague here, White House reporter, said potentially it's an olive branch to the Joe Manchins in his party.
Do they think they can get something done with Senator Manchin still?
Potentially there could be things that can get done not as an entirety of a bill, but carve-outs of a bill. Maybe a smaller package on climate, maybe something smaller on prescription drugs, but not what we talked about 6-7 months ago with this massive bill to get really a number of agenda items that they ran on into one final piece of legislation. I mean, I don't know how many times Joe Manchin has to say it, the Senator for West Virginia, but he has said a number of times that legislation, Build Back Better, is dead.
Just quickly, there's only been one story that's dominated the news cycle in this country in the last 24 hours, and that's on abortion rights. The controversy over the substance of the leak and the leak itself. Can you walk me through how the administration has responded to this, how they are looking to respond to it in the weeks and months ahead, going into the midterms now?
So on one side, you have the Republicans really talking about the fact that this was a leak, it was egregious, and you have the Supreme Court saying they will go after the leaker. The Democrats are obviously leaning into the content of that leak. And we've heard last night from Vice President Harris, really in the most robust and impassioned speech we've heard yet from the administration, about how this is attacking self-determination of individuals. What we know this administration is going to do is going to be a huge rallying cry, Jonathan, going into the midterm elections. The president already said that himself. He said if this 1973 Roe v. Wade law is struck down, then it is up to legislators to codify this into law. That also means in November for Americans to elect individuals that are going to run on this. And Jonathan, just quickly, what we've seen in the past, like when late Justice Ruth Bader Ginsburg died, that was a huge moment for Democrats to get campaign dollars. So they are going to really push this over the next few months into November as well as into 2024.
Looking forward to see if it does indeed change the polls. AMH, thank you. The president speaking at 11 a.m. Eastern time, as someone emailed me just moments ago. Of course, he's scheduled at 11 a.m. Eastern time. That lines him up to be right on time at 2 p.m. Eastern. 2 p.m. Eastern, of course, is when you get a Fed rate decision. Then 2:30 Eastern, the Fed chair, Jay Powell, in a news conference. I will not tell you who sent me that email, but joining me now is Bloomberg's Mike McKee. Mike, final word ahead of Chairman Powell a little bit later. What are you looking for?
Well, we've got some good news for the chairman and for Joe Biden. The latest PMI numbers out from S&P Global show that services PMI went up significantly to 55.6, and the composite went up to 56. We get the ISM services number at the top of the hour. Shows strength in the economy, and that would help the Fed in its efforts to raise interest rates without sending us into recession. Of course, the biggest indicator that we've had recently, the JOLTS numbers for March coming out with 11.5 million jobs open right now, the most ever. That's the white line there. The blue line is the number of people who got hired. There is a big and growing gap. So the Fed can argue we're not going to tip the economy into recession or push people out of work when there's 2 jobs available for every 1 person who is looking.
What a stat that is. That is just an incredible number. I think it's 1.94, the precise number, but whatever, close enough to 2. Mike, this is interesting going into payrolls tomorrow. The median estimate is 385. The range has been wide for the last 2 years. You know that. The high is 517, the low is 250. I keep going back to this from Citi about this shrinking pool of available workers should soon start to limit the monthly pace of job growth. They're looking for 360. Mike, are you looking at the same thing, that maybe we need to start getting used to a lower number?
Yeah, you've got to figure that that's going to start happening because so many people have come back into the labor force. You wonder how many are left outside and why they would be left outside. There was the whole argument that they got the stimulus checks and didn't have to go back to work, but now those are over, so it is time to have a paycheck. And if people are still looking, that suggests that at some point we're going to run out of people who want a job unless we pull people in who aren't looking for work. But there have been a lot of retirements, the baby boomers getting to that age, and so it's very possible that we see smaller numbers going forward.
Mike in Washington, that's good to see. Mike, are we finally doing an in-person news conference? Is that back?
That's back.
Awesome.
Haven't seen Jay Powell in person since March 2020.
Wow. Looking forward to that, Mike, and looking forward to the grilling you might be able to give him a little bit later, although, as most people realise, Mike is usually saved for the end of the news conference and then Chairman Powell runs away. I said it, Mike, you didn't. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. Looking forward to running through the week ahead and the day ahead as well, with some special live coverage coming up on that Fed decision. With the surveillance team, I'll be catching up with Tom Keane and Lisa Abravis and Michael McKee at 1 p.m. Eastern Time. Your week ahead coming right up. Five minutes in, equities basically unchanged on the S&P. On the Nasdaq, down about 0.33%. In the bond market, yields creeping higher going into that Fed decision. A little bit later with Chairman Powell, yields up 3 basis points on a 10-year, back through 3%. On a 2-year, the highs of the year at 282.56, up 4 basis points. That's the price action. Here's the trading diary at the top of the hour. ISM services data. Then President Biden, he now delivers those remarks on the U.S. economy at 11 a.m. Eastern. We get a Fed rate decision at 2 p.m., followed by Chairman Powell news conference at 2:30. The Bank of England with their own rate decision tomorrow morning. Plus, we get another round of initial jobless claims in the U.S. And finally, rounding out the week with the U.S. payrolls report on Friday. The median estimate so far could change over the next couple of days, but at the moment at least, 385K, the previous number in the previous month. Back in March, 431. From New York, I'll catch up with you later for the Fed Show. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Vaynergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Vaynergold as an opportunity to leave that troubled home. Vaynergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Vaynergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Vaynergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Vaynergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there, like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
You find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and, well, space is really big. And then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations, which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.